Good evening, everyone. I, CA Ravneet Kaur, practicing chartered accountant, welcomes you all to the very important and insightful session on the topic Understanding the Investor Relations Metrics, Important or Compliance, that is organized by the Committee on the Financial Markets and Investor Protection ICAI. The Committee on Financial Markets and Investor Protection works in the area of promoting investor protection by nurturing capacity and competent development of members and stakeholders in the financial market and have been actively working in the area of financial literacy for the development of the economy through its various learning initiatives of workshops and training programs. The committee of ICA is also tirelessly working day and night on the mandate of Government of India for the development of the domain of the financial markets by regularly updating and educating the potential as well as existing investors through its knowledge enriching investment awareness programs. The committee provides suggestions on various bills, notifications, circulars, and other documents related to financial markets to the government and regulators. Besides this, the committee regularly interacts with MCA, RBI, SEBI, Insurance Regulatory Development Authority, Forward Market Commission, and stock exchanges on the issues related to financial markets, role of CAs, and investors' protection. The committee is currently working under the chairmanship of CA Charanjot Singh Nanda and Vice Chairman CA Kotha S. Srinivas. CA Charanjot Singh Nanda, who is very renowned personality that we all know. He is one of the most knowledgeable persons I have ever met, and I have always been motivated after attending his sessions. He is presently the Central Council member of Institute of Chartered Accountants of India. He is a chairman of Digital Accounting and Assurance Board ICI, Committee on Financial Markets and Investor Protection ICI, Committee on Information Technology of South Asian Federation of Accountants, and Vice Chairman of Board of Internal Audit and Management Accounting. He is also a member of Quality Review Board set up by the Government of India. He has been the chairman of the committees of the Institute of India, Accountants of India, such as Internal Audit Standard Board, Committee on Management Accounting, Committee on Internal Audit, and many more. I now introduce our eminent speaker of the session today, that is CA Ankit Maheshwari sir. He is a highly accomplished and dynamic chartered accountant with an exceptional track record of over 15 years of professional experience spanning various geographies. With a strong focus on enhancing financial reporting framework of large listed companies in India, he has established himself as an expert in assurance. He is also the visionary founder of Edwin Advisory Services, a management consulting firm that has successfully worked with some of the top listed companies in India. He has been actively involved in various government initiatives in Rajasthan, where he is a trusted advisor for channelizing investments in the state. As a former secretary of Jaipur branch of ICA, he has been an active member of the organization for several years. His contributions to the finance and accounting industry in India have been immense, and he continues to inspire and shape the future of the industry. Now, I request CA Ankit Maheshwari sir to please initiate the today's session.
Thank you so much, Ranveer, for such a warm introduction.
Thank you, sir.
And indeed, the position of moderator is a very critical position when with webinars. So I am not letting you go after introducing me. You have to help me navigating this session
Sure, sir. Sure.
as much as possible. And we all come from same background. We all are chartered accountants. So
Yes, sir.
I'm sure when the tricky questions comes up, I'll look up to you for sure.
Sure, sir.
Thank you everyone for joining on a Saturday evening. Not sure, whether it's an appropriate time to keep a webinar or not. But I think hats off to the Committee on Financial Markets and Investor Protection to, keep it at and make it sure that this happens at a very short notice. And it talks about, the session entirely talks about a very important topic, which is pertaining to the investor relationship matrix. And we will deliberate about how important this investor relation matrix is what constitutes an investor relationship matrix, what is important, what is significant, what is essential, and what is a compliance which we need to do. This session is before I do the formalities. I'll tell to all the learned audience who have been here that this session is in a background of lot of things. So Ranveer, while I was preparing for this session, so we had a lot of background into it. One, the change which happened in the LODR regulations on 14th July 2023, which brings a lot of anxiety, confusion, dilemma in the entire listed entities and the corporate reporting teams, as well as their compliance team, as well as to an extent the auditors who are supporting it. So one thing which we are definitely deliberating when Kuldeep joins in this session is about LODR, regulation and the change which came on 14th July 2023. We'll try to dive deep into that change. The second thing which comes is while we are preparing an investor relationship matrix is significance of an investor presentation, an earnings presentation. What should constitute an investor presentation? Uh, be it, while the CEO of the company is addressing the non-financial part, and when the CFO is addressing, and as an IR team member, as an investor relationship team member, or somebody who is the reader of this entire investor presentation, how do you dissect this presentation? Will be one aspect which will form part of the matrix. The third thing, which I think is an annual communication, is the annual report, and what constitutes, what should be a part of an annual report that needs to be looked into, the financial part, the non-financial part. Uh, we as chartered accountants always discuss the financial disclosures and the financial part, but Ranveer will try to, give thrust on the non-financial part also, be it the corporate governance section, which is again a critical part of investor relationship, a management discussion and analysis section, a business responsibility and a sustainability report attached to it. Even we'll go, what should be a constituents to a chairman's speech in an annual report, a chairman's speech while presenting in the AGM, and how market perceives at it. That shall also be covered. And what are the commonly found mistakes in the non-financial part? We'll not miss the financial part. Being chartered accountants, the financial disclosures have become very important. And Ranveer, you must be aware, and everyone here must be aware about the 31st March 2023 notification, which talks about moving from significant accounting policies to material accounting policies. And this is a very interesting development. As chartered accountants, we play a very vital role into all this. So we'll discuss the financial disclosures and how investors perceive the financial disclosures. We will also discuss the change, and that's a very critical change. As a fraternity, we need to address that change, be it whether we are on auditor side or be it whether we are on the client side or the company side. So with all this in mind, and lastly, I think Ranveer and team will try to figure out if there are some forward-looking disclosures which we see. For example, the integrated reporting. There's a lot of confusion with integrated reporting. As of now, various companies in India are preparing integrated reporting. But what should be an ideal integrated reporting needs to be looked. The IIRC framework needs to be benchmarked. So we'll try to deliberate on all those six capitals. They are also important way to communicate your investor relationship matrix. Uh, if time permits, because I and Ranveer have opened up many areas here. So, if time permits, we'll try that, we pick up some parts of the sustainability reporting. So the flow of the session will be very clear. First, we will discuss the material accounting policies. Then we will discuss the impact of these material accounting policies, and then we'll discuss the investor relation through a We'll take up one of the investor presentations, Ranvit. Any presentation we can download it from internet, and we can look up to navigating the entire presentation and ask few questions to the audience also, and what should be an ideal investor presentation. Then we look into the integrated reporting framework, uh, then the LODR compliance. So that has to be the primary flow of the session. Uh, and in between, we will also cover various aspects of the annual report. So that should be the flow. Uh, let me first thank the entire committee of financial markets and investor protection. Ranvit, you were rightly saying, Nanda sir is a exemplary figure in our institute, and his contributions have been various, various committees, even on national forums, international forums, has been immense. Not only you, even I have been his student, and we all derive a lot of inspiration from his
Yes, sir.
deliberations. We
Yes, sir.
expect him to join in few minutes. As
Yes,
he
he
joins,
will be joining, sir. In
he's
few
in a
minutes.
flight.
Actually, he's
He
traveling, so
right,
he will
right.
be joining. Yeah.
But we look forward for his deliberation. I would
Yes.
also place my thanks to the vice chairman of the committee, CA Kotha S. Srinivas ji, who unfortunately would not be joining, but he is somebody with whom we started this series of excellence in financial reporting in last 3 months, and we covered all topics. So he was somebody who was always available for help. And there's a lot of deliberation before we come into this session on all the fronts I was talking to. Uh, the entire team of the Committee of Financial Markets and Investor Protection, who have been waiting on a Saturday evening to make sure that it is happened, especially Giverji and the technical team. Thank you so much. And now, finally, I would want to place my thanks to Ranveer for helping us into all this. And Ranveer, let's now begin with straight to
Yes.
the technical part of it, right? I'll share my screen, and in case if you face any issue, just Ranveer, let me know,
Okay.
right?
Okay.
Ranveer, is it visible?
Yes, sir.
Okay. So I think I have already given the brief background. I'll straight away come on the first thing, which I think as a part of investor relationship matrix is a critical change. Is earlier we used to use the word significant accounting policies and estimates, right? Uh, n- Significant accounting policies and notes to accounts. This significant was never defined before. When you look at Ind AS 1, so what is a significant accounting policy? This has never been defined. On 31st March, when MCA came out with this notification of amendment into Ind AS 1, that is something which I want to deliberate, and how does it impact the investor while he is reading a financial statement. That's something which we will be deliberating. But uh, question to audience: what is the difference between this significance and material? How does it, how do you perceive this difference? And when we will look forward for some answers.
Yes.
I am again repeating my question. My question is that earlier we were using significant accounting policies and notes to accounts or estimates and judgments, which was in compliance with Ind AS 8. We will also, go on the technical part of it. Now, on 31st March, MCA says we are moving from significant to material. What is material here, and how does it affect the financial statements and its notes to accounts? Anybody who can, give me quick answers on it. What is the difference between significance and material? Ranveer, there is always a lag in the session between while we are live and the
Yes,
audience
sir.
answers. So you might have to see
Mm,
for 5, 6, 7 seconds
uh,
if somebody answered
yes,
this.
sir. Yes, sir.
You have the access to answers, Ranvi?
Yes, sir. Yes, sir. I have opened the link and the window is in front of me, sir, in another.
Okay. So in meantime, Ranveer, let's go
Let's,
slightly detail into it and let
yes,
us
sir.
see how many participative audience we have here.
Okay,
Uh, so
let me
so
see.
one, why there was a need of an amendment, I told you previously also. The need of the amendment arises from Ind AS 1, where Ind AS 1 required the companies while preparing their financial statements to disclose their accounting policies. But what to disclose was
Uh,
not
uh,
not
Sorry, sir. There is one answer to the question you have raised.
right,
Uh,
right, right.
Sumit Jain from Jaipur, and
Okay.
he has answered that material means only important, significant means related to. Uh, Wait a minute. Sir, he has answered that material means only important.
Okay. So very correctly, that could be the crispest answer. One important thing when this change came. So Sumit and everyone who has been joining this through the webinar, one important thing which this notification mentions is that the insignificant policies which are coming up, that is sometimes when you write your notes to account, you start reproducing the language of India. And when you start doing that, right, so something which is mandated by a law, you start writing that law in an annual report. And that does not solve the purpose. Rather, overwriting these notes to accounts and policies, as rightly said by Sumit, uh, creates a problem of obscuring a material information. So when you read these notes to account, sometimes you feel that you have been reading the India's as it is, right? So which now will not be there. We will take 4 or 5 examples around accounting policies. We'll open some annual reports and we'll try that, if we can foresee that change. So when this materiality principle has come, right? So they are talking about two, three critical issues. One, they say the we can read this point. The second point on your screen, the simply reproduce the requirements of the accounting standard in brief is something which MCA wants to get away from, which NAFRA wants to get away from. And that's agenda one. Agenda two, the company's accounting policy disclosures were the best reference to understand summarily the requirement of India. Such disclosure did not provide it information on how the standard requirements are applied company specific. That means now you have to give company specific disclosures. For example, for example, I was reading annual report of Vedanta and I was looking at their property, plant and equipment policy. When you look at their property, plant and equipment policy, they give their property, plant and equipment policy the measurement and the subsequent recognition policy, the initial recognition and the subsequent recognition policy with their sectors. In their oil and natural gas, their initial recognition starts with an exploration, while with the metals which they have been mining, the initial recognition or the mining lease of the asset is recognized in a very different way. And the other property, plant, and equipments are recognized in an entirely different way. So when you look at it, you see a very detailed policy, and now 80% of the policy will be, reproduction of Indes itself. So whereas when you look at some other company, you will realize that they are just talking about the initial recognition and subsequent recognition part of the property, plant and equipment. I'll try to open an annual report and navigate you with this disclosure. But what I am trying to say, if this information is company specific, then a significant accounting policy, a significant notes to accounts should now be company specific, should now correspond to the operations of the company. The third thing, right, what whether a transaction, event, or condition reported in financial statement would make accounting policy for the same significant to be disclosed. So Ind AS do not define the term significant, but let's look into the detailed part what change has come. So with regard to this change, material is defined and understood by all stakeholders, right? So what this change says, I am reading para 117 of Ind AS 1 and which has been reproduced in the slide also, that accounting policy information is material if when considered together with other information included an entity's financial statement, it is reasonably expected, this is important, to influence decisions that the primary users of general purpose financial statement make on the basis of financial statements. So when you read a policy, any policy, you will have to look into this whether it is influencing the decision or not. Now, every time you read a policy, you realize that this kind of a transaction is influencing. But now they have given a test also. So only this condition satisfaction doesn't mean that you have to disclose a accounting policy as a part to your notes to accounts. So the test here is if the transaction is omitted or misstated or obscured, whether that would influence the economic decisions of the users or not. So let's go on the test. When you look at the test, right, you will realize few things here. So one, the opening line is already being discussed, whether it affects the uh, decisions or whether it influence the decision of the user of the financial statements or not, right? But they transaction, and if it requires some kind of a clarification to be given to the stakeholder, then you have to put your notes to accounts. Then you have to put your notes to accounts into it. The second thing which says that if there is a change in accounting policy, then also you have to put your notes to accounts or significant accounts. Alternatively, if Ind AS permits you, two options, one, two or more options, and you exercised one options. For example, when we'll study a property, plant, and equipment policy, I'll tell you how do we analyze it. Then also you have to mention that what option you have exercised, or it is a significant judgment or estimate or assumption which you have made in reference to when you read paragraph 122 to 125 of Ind AS 1, you realize that fact. So let's go more deeper into it. But there are two tests which somebody has to pass. Test one, whether the information is material for the user of financial statements or not. When we say it is material, we are saying whether it is affecting the decision making of the user of the financial statements or not. If that is happening, then you have to undergo few more tests, which we just deliberated. Let's go into a simple accounting policy, Ranvit, and then we go into a technical accounting policy. I'll try to open any annual report and we can discuss the financial instrument policy also. We can discuss the PP policy, impairment policy. We can discuss, right? So now the question is, after this amendment, whether the cash and cash equivalent policy shall be disclosed. So when you read an annual report, it's a common cash and bank policy which I am mentioning here. Every company mentions it, right? Now you look at this policy. The policy says the cash and cash equivalents include cash on hand and other short-term highly liquid investments with original maturities of 3 months or less that are readily convertible to known amounts of cash and which are subject to insignificant risk of change in value. मेरे हिसाब से जब हम सभी कंपनी की एनुअल रिपोर्ट देखेंगे, when we look into the annual report of every company, this cash and cash equivalent policy exists. My question is, after I told you the material event, the policy or the change in the materiality, will this policy now come from next year or not? So will we, if this is the exact reproduction, will this policy now be forming part to the notes of accounts or not? Ranvit, look for some answers here.
Sir, there is one question from Sachin Kumar, Mumbai. He is asking that, so in case of diagnostic industry, policy on revenue recognition can be once report is delivered, will this fall under material rather than significant?
Sachin, we will take this question with this topic itself. I got your question. The question is about the revenue recognition policy and how, whether we in service industry, whether we have to, mention this, how it is delivered, it is received, it is booked on the delivery of the service. So we will cover this after this example. We will take this example only, and Sachin, we'll do it together, right? But as of now, the question is simple. The question talks about whether the cash and cash equivalent policy will henceforth be disclosed as a part to the notes to accounts to the investors. Ranvit, I'm looking for some answers. We'll wait for 3-5 seconds since
Sure, sir.
you know.
Uh, Sir, one person has answered, Sachin Kumar from Mumbai.
Right.
He is saying, I don't think this should be needed as nothing specific in this.
Absolutely. I think Sachin, so we have come on same page. If you receive any answer, let me know, Ranvit. Else we move and I'll try to dissect to that test of materiality. And then we pick Sachin Kumarji's question of revenue recognition. Okay, let's let's see why Sachin and I feel that it should not be a part to this. So one, I told you there are two steps. Step one, whether omission of this statement influence the economic decision of the users. Yes, every user would want to know. But then there is step two, which we need to follow. That whether the company has changed its accounting policy and the change has a material effect. So there is no change. Whether the policy has been chosen for one or more options. Ind AS 7 doesn't gives you, too many options of cash and cash equivalent. Whether the company developed the accounting policy applying para 10 to 12, which is the accounting estimates of Ind AS 8. We will also study what does para 10 to 12 say after this. Whether the policy requires judgment or assumptions. No, there is no judgment assumption. It is as it is, a clear mandate comes from Ind AS. and in case a company is expected to apply more than one Ind AS. So that is why when you look at it, the cash and bank policy will not be cash and cash equivalent policy will not be considered material. It was significant. It might still form part of the accounting policies which are maintained by the company by their in-house teams, but will not form part of annual reports from the period beginning on or after 1st April 2023. So when you read the next annual report, you will not find this. Also, if there is a disclosure requirement of a particular index, right, then obviously that disclosure requirements are required to be met. So there is no option to the disclosure requirements. This only comes as a part of policy. If an index expects you to disclose something, you have to. So that there is no excuse to it. Now, I think let's pick up, Ranveer, let's pick up Sachin Kumarji's question and
Yes.
try to pass it through this test. Okay. Can you put up the question again?
Yes, sir. So, in case of diagnostic industry, policy on revenue recognition can be once report is delivered. Will this fall under material rather than significant?
So, uh, in general case, right, when we look into diagnostic market, and Sachinji, correct me if I'm wrong, right? Generally, the revenue is recognized at the time of while somebody comes at the counter of a diagnostic industry, right? And when he comes at the counter, you raise the test slips that all these tests he will undergo, and after that there is an invoice amount which is given to you, right? Now when this invoice is given, there is a still the service is not given, but there is a receipt of money. Now the service is given in tranches. A service is given when the test is performed. A service is given when a report is delivered. Now, Sachinji, if it is an industry practice, if it is a standard industry practice that all the companies recognize their revenue at the time of uh, Ranvit, we have been joined by Kuldeep ji.
Good evening, everyone. Sorry for being late. Good evening, Ankit ji. Good evening, Ramneet. How are
Good
Good
you?
evening, good
evening,
evening.
sir. Welcome to our session, sir. Today's
Thank
session,
you.
sir.
Thank you.
Uh, I'll just complete this.
Sure,
Kuldeep ji,
sure, no problem, please.
so we were discussing the materiality policy, and we
Hmm.
had this question uh, that from a diagnostic chain which
Hmm.
says that we recognize our revenue recognition policy
Hmm.
based on at the time of the revenue is recognized at the time of when the reports are delivered to the customer, right?
Okay.
So I was just answering it just to give you a brief background to this.
Yes,
So
sir.
I am saying that there are steps at revenue recognition. One, when the invoice is generated, however the service is not performed, right? Then the
Hmm.
test is done, and
Hmm.
eventually the reports are delivered either through WhatsApp or through apps or even
Hmm.
through hard copy.
Hmm.
If it is a standard industry practice, right?
Hmm.
So in a service industry of a diagnostic chain, then this policy will not be expected to be disclosed.
Hmm.
However, Sachinji, you can only confirm me if there is some other practice. That is, if certain diagnostic chains recognize this revenue based on the provision of services, then in that case there might be a case that then you have then as we were discussing in the beginning of the session, you might have to disclose this specific to the company. So if it is specific to your company, if it is a estimate, if it is a judgment, if it is a different practice, then you have to disclose it. So do we have any answer from Sachin on this?
Sir, let me see. Uh, no. No, sir.
So I think I have answered it clearly. If it is a standard practice across all diagnostic chain, and where the revenue is recognized at the time of delivery of report, right? Uh, Even if the revenue is recognized at the time of provision of service, right? Then also I don't think it will make any significant impact, and that is why we can avoid. However, if it is specific that you charge from your customer only when the report is delivered, it's a different case, and then it will require specific disclosure.
But sir, in general, I think it is not the case na. In diagnostic chains also, the charge upfront before the delivery of report, and delivery of report is not the always
Essential
done
condition.
case. It is not the essential condition for,
That is
because
why
in
I'm
many
asking
cases,
this question. Correct,
yes,
correct, correct.
because in many cases, if you talk about ourselves also, we get say some sort of test done, uska koi message aata hai and we'll see, then in many cases we don't go to collect reports also. So in all cases, in these days the reports are available online itself. So you
Correct,
receive a lab ID and password along with the receipt when you pay for the testing, and
correct,
you
correct. And
can
you
download
you
the
can
report.
retrieve it. You can
Yes,
retrieve it
yes.
on your mail. But if the company is charging
Hmm.
at the time of report downloading only, that
Hmm.
could be another, because a lot of
Yes, sir.
diagnostic chains have come, startups have come into practice. And
Hmm.
if that is happening, then I think there it requires a very specific disclosure. Ranvir, do we have any other question?
Uh, Sir, there is answer to the question you have raised from two persons. One cash related question. Yes, in my humble opinion, as this will continue to be material item. This
Okay.
is Mahir Javeri from
Who
Ahmedabad.
answered this? Who answered this?
Mahir Javeri from Ahmedabad.
Mahir ji. So I think now, you might be aligned to the thought process why this circular has come up. And even when I read it in a blanket way, I also felt that you can't avoid a cash and a cash equivalent policy, and that is why I and Kuldeep ji decided to deliberate on this example. Still, if there is any confusion, you put up in the chat box. We will again discuss it, because this is a new change. Will undergo discussions. Everything what I and Kuldeep ji deliberate might not be correct. I am being blunt here, because we are undergoing. There is no precedent. We are only setting the precedents, and that is why we wanted to discuss it. So we as chartered accountants are open to discussion, open to all kind of queries, and if something goes wrong, we are more than happy to deliberate again.
Ankit ji, have you discussed that boardroom example that we had a few days back about
Kuldeep ji,
meeting with
no,
it?
you can start, and then I'll join in the discussion.
Okay, actually, we were meeting a CFO of a very big conglomerate of a Indian listed company. So we're discussing these changes of material accounting policy only. We're discussing that how from significant to material they can move and what impact the company is going to have on this. So talking about this cash, it has practical riders attached to it. When you see on the basis of amendment which has come, cash and cash equivalents is not a material accounting policy per se based on this test, which is required to be reported. But he was of the opinion, the CFO was of the opinion that yes, it is not a material accounting policy based on the materiality test that we are discussing, but from business perspective. So these conditions says that even if you disclose, it is material, but it is not required to be disclosed. If you disclose and if you give accounting policy of cash and cash equivalent, it is not going to do any harm on the company's side or for the investors per se. But they said that when they go for any investor presentation, investor roadshows, when they go abroad for funding purpose, when they do such rounds, every investor analyst or research analyst asks the same question: what is there in the cash and cash equivalents?
Right.
Because in that particular case, for them, debt and the cash and cash equivalents are very important aspects of their balance sheet. So if
Correct,
you
correct.
take the literal meaning, or if you take the constructive meaning of this amendment, cash and cash equivalent materiality policy is not required to be disclosed, but it doesn't mean that it is not a material item. So maybe on the test of this materiality concept, it is not required to be disclosed, but for the other purpose, if your business requires so, or if there is any requirement of any stakeholder which has a say in your board or say in your decision, then you can report the same. The statute or the standard is not asking you to stop. Over to you, Ankit ji.
Only thing which I told them after, we had that very interesting discussion, that I hope you got what Kuldeep ji was saying. Kuldeep ji was trying to deliberate that, while this company do not disclose, their bankers, their investors, everybody ask what is what constitutes your cash and cash equivalent. In this company is a high debt company. So while it is a high debt company, there might be a lot of investors interested in knowing what they are keeping up it in cash and cash equivalents also. But importantly, when you disclose an insignificant policy, right, there has to be a clear logic backing you up. Otherwise, tomorrow SEBI might start considering it as obscuring
Exactly.
of an information. So if this company has a logic, this company needs to document the logic also of disclosing a particular policy. So my suggestion is to all the companies and auditors who are helping these companies to disclose, kindly back up with a documentation of this materiality test, so that tomorrow nobody can stand up and say you are obscuring an information. And if that happens, then what could be an impact that needs to be still assessed. Kuldeep ji, I was thinking after, there are two basic examples, but I am very keen of taking any annual report and picking one or two more policies for a better clarity.
Exactly. It
If
will
you
be
can
helpful for
support
the.
me, if Ranveer can support me, let's
Sure, sure.
open an annual report. I'm opening an annual report. Let's look into any policy. Give me a minute, so that I can just do the navigation part, and then let's ask the other views also, and what we three of us thinks.
Not an issue. I think we should, proceed with the webinar in that way only, because it will be easy for to understand. Every industry have different sort of priorities and materiality
Right.
attached to its business condition. So maybe for a company which is a very highly liquid company and which is not risky or a low beta stock, it is not important for them to disclose cash and cash equivalent. But maybe a company which is in news for its debt related issues, it will be a significant part for the investors who are associated from outside. So in that case, they will disclose the cash and cash accounting policy or any other policy. So which annual report you are opening, Ankit ji?
Give me a minute. I'm just looking at it. Right. Okay, I am open for Infosys.
Done.
I think it's a report which many users also benchmark. I hope it is visible.
If it can be zoomed a
It
little
can
bit,
be zoomed, right?
it will be better for you.
Better?
Yes.
Still, should I zoom it more?
If it is possible.
Okay.
Yes.
Fine.
Okay.
Fine. Fine.
Good to go.
Good to go, sir.
Okay. So Kuldeep ji, let us read an impairment policy. Say I am randomly, using these accounting policies. Now, impairment of, I think this is for intangible, right? Or we can take intangible also, right? Now, this entire policy needs to be very carefully looked into, right? And we need to see where the company is doing an exact reproduction of Ind AS,
Exactly.
and where it is a company specific practice or company had an option to disclose or had to make a judgment, right? Now, I am reading the policy for you of an intangible. which says goodwill represents the purchase consideration in excess of group's interest in the fair value of identifiable assets, liabilities, contingent liabilities of the acquired entity. When the net fair value of identifiable assets, liabilities, and contingent liabilities acquired exceeds purchase consideration, the fair value of net assets is reassessed and the bargain purchase gain is recognized in capital reserve. Goodwill is measured at cost less accumulated losses. To my opinion, Kuldeep ji, this now will not become a part to the significant accounting estimates of Infosys. This is a standard practice of measuring a goodwill, and there is no alternate. So we only disclose goodwill in the books, which is an acquired goodwill, correct? As per
Agreed.
Ind AS. Now I am looking at the impairment policy of it. Goodwill is tested on an annual basis, and whenever there is an indication, right? Now this is an estimate which you have to make. There are companies which might test it because Ind AS doesn't require you to tell कि ये टेस्टिंग क्वार्टरली करनी चाहिए, 6 month करनी चाहिए, 1 year करनी चाहिए, right? This could be a company specific practice. However, all the annual reports I have seen, it's again a standard reproduction. And now when we are saying when an impairment is done, when there's an indication of a recoverable amount of CGU is less than carrying amount, reproduction of Ind AS won't come. For the impairment test, goodwill is allocated to CGU or groups, will not come, or CGUs when benefit from the synergies of the acquisition, which represent the lowest level at which goodwill is monitored for internal management purpose. Now this company starts defining CGU, which is a reproduction of Ind AS again,
Exactly same.
right? Anybody in this audience can tell me what is a CGU, right? And that is defined as per Ind AS, correct? So now all these things, the policies becomes very crisp, and you have to start working from now because we are, Kuldeep ji, we are in September. When
September
you look
itself.
into one accounting policy, this is from a standalone point of view. I'm saying tomorrow when we discuss with Infosys, they'll tell their logics of putting this or not putting this. So all these accounting policies needs to be backed. Kuldeep ji, if you read the financial instrument policy, same problems.
It is same because Ankit ji, when you take the example of reproduction of any wordings of Ind AS, you see the same definition or the same paragraph given in the CIPLA's annual report. So it is completely in different business segment, but still the policy is same. If you see the annual report of say Vedanta, or if you see the annual report of HUL also, then you will see the same sort of language which is being reproduced. The
Exactly.
reason being it is reproduced because it is given in the Ind AS. So the actual intent of giving an accounting policy is that you give in a company specific accounting policy. It helps the users to understand that what financial information, what transactions has happened and how it is being captured. So instead of that, we are reproducing the Ind AS language, and which is not a correct practice. And that is the intent of statute behind coming up with this amendment, if I'm not wrong.
Correct. Now, importantly, similarly, you might not hold so many financial instruments.
Yes.
So the financial instruments that you hold, you need to give policy to it if there is an option which is provided as per Ind AS. So in case there is an option where a financial asset is carried out at amortized cost and a financial asset is carried out through OCI, so there is an option which an Ind AS gives you, and that is why this might need to be disclosed. You can't remove everything. Now I'll tell you the important problem into it. And on this session, so what happens? I think everybody in this session would be understanding the quantum of advisories NFRA is also giving. Now, NFRA is able to give so many advisories because we have provided them with so much of information.
Mm.
You say it is material to me. You say a financial asset policy is material to me, and by a what constitutes a financial asset. You give a policy of trade receivable. When you as it is reproduce the policy, Kuldeep ji, there is a problem which arises. Now, if that
Exactly.
reproduction is done incorrectly,
Mm.
NAFRA pitches in. So that is why, on a safer side, we have to, cutting it short, concluding it, we have to look at not reproducing any language of India. When you do that, Kuldeep ji, wo PSP wala projects
Yes,
mein,
yes, exactly.
they gave an advisory when you were talking about financial assets.
Mm.
So they said that you are talking about other contractual assets, you are talking about trade receivables. Why you are not talking about bank?
Mm.
Whether impairment of bank needs to be done.
Mm.
Everybody can go to NAFRA's FRQRB reports. Now I have this question also,
Mm.
Ranveer. Let's
Mm.
wait for this. The question is whether a bank account needs to be impaired. Now, when you start as it isly reproducing in days, I'll tell you what happens. Whether to all the audience here, my question is simple: whether a bank account needs to be impaired. Ranveer,
Or
we'll
we
wait
can
for
say
answers.
deposits or FDR also.
Right,
Mm.
even bank deposits,
Bank deposits.
deposits with nationalized banks. Any answers, Ranveer?
Nice. No, sir. Right now. No.
Kuldeep ji, I was talking about NFRA
Mm.
advisory. Now you look at
Mm.
the initial recognition policy for Infosys.
Mm.
In meantime, we will find an answer, right? Now, all these companies before this 29th March 2023 advisory come, they were writing in their annual reports that group recognizes financial assets and financial liability when it becomes a party to the contractual provisions of the instrument. All financial assets and liabilities are recognized at fair value on initial recognition,
Except mm.
except for trade
trade
receivables,
receivables.
which are initially measured at transaction price. Now, because we were reproducing this in days, there is
Mm.
an advisory of NFRA coming that because a lot of companies were writing the trade receivables, they were not specifically mentioning about the trade receivables. They were just writing that all financial
Financial
assets and
assets.
liabilities
Mm.
are recognized at fair value on initial recognition. On
Or
which now,
mm.
sorry, please, boliye.
Just to interrupt, they were writing like that all financial assets are recognized at fair value or transaction price, but they were not mentioning about the trade receivables to be
Correct.
specific.
Now,
And
because we were as it is reproducing this in there, sorry, I missed it.
yes, yes. No, sir, we lost your connection, but I just stopped my thing.
Okay,
That I was
you
saying
you
that. Hmm.
you
I was
complete it.
saying that before initiation of this PSP projects proceedings and before NAFRA came up with a specific advisory on how to identify and how to recognize and trade receivable, the companies were writing that for all financial assets they are being recognized at fair value or transaction price, and this was because they were trying to copy and reproduce the language of Ind AS only. That was the main problem behind this. When contacted upon, they said that many of the big companies were doing Ravneet in till last last year before this circular came into place. And they said that practically they are recognizing trade receivables at transaction price only, but since their accounting policies were not looked upon into, and they were like trying to reproduce the language of Ind AS, they were making this mistake. I'm right, Ankit ji, this was the case, na?
Correct, exactly. So that's why I'm saying all this needs to be reassessed. Where in all cases, trade receivables, if they are not a part of significant financing component, needs to be recognized at transaction price itself. So, did we receive any answer, Ravneet,
Not
for the
yet.
bank accounts?
No, sir.
Okay.
Not yet.
So if you write this, then you have to mention whether your fixed deposits will undergo an impairment or not. Because then you have to know why only talking about trade receivables, Kuldeep ji, right?
These
Then you
other
have to.
contextual assets are required to be
So ideally,
tested for
a bank
impairment.
account, a fixed deposit undergoes an impairment, and the practice is based on the change in the credit risk of the bank in which you are keeping your deposits. So if you are keeping a deposit with State Bank and the credit rating of State Bank changes, right, significantly, then you have to provide for an impairment allowance. Nafra did not even took that plea, Ravneet, that they did not took that plea that the bank account is with SBI and SBI ko kuch nahi ho sakta. There is nothing like that. There is nothing like that. So I think we have enoughly deliberated on this issue. That is one part of our topic where now investors will look for material accounting policies. As professionals, we need to adopt into the new role. We need to start working around these policies very quickly. And then now we move to the next part of it. But before this, Ravneet, by the time I change the presentation, we have not even introduced Kuldeep ji.
Yes, sir.
I
Sure,
request
sir.
you to give him a formal introduction.
Yes, sir.
इतना flow में रह गए session के
Yes.
नहीं, sir.
we forgot that.
Let me introduce our eminent speaker of today, CA Kuldeep Kothari, sir. Welcome, sir, again.
Thank
CA
you.
Kuldeep Kothari is a fellow member of Institute of Chartered Accountants of India. He has expertise in the field of FR framework and ESG reporting advisory, direct and indirect tax litigation, investment and startup consulting. He is a qualified company secretary. He has qualified CA and CS exams with all India ranks. He has qualified the DISA exam of ICAI. He is also a certified forensic auditor and peer reviewer with ICAI. He is impaneled as a head technical reviewer with ICAI, research committee for FRF, and principal researcher of research study on application of revised formats of financial statements in education institutions, central universities, and impact study. He was co-opted member of Public Finance and Government Accounting Committee of NIRC of ICAI. He has written books on investor awareness and financial topics for the Institute of Chartered Accountants of India and many others. He has delivered many lectures on various topics such as FRF, income tax, GST, investment, investor awareness, and personal finance, and many more. So I now request sir to continue the session.
Thank you, Ravneet, for this wonderful introduction. And thank you, Ankit ji. Let's continue with the flow.
Right. So I think Kuldeep ji, I briefed when we were starting
Sir,
the
I'm
session.
really sorry to interrupt. I guess Nanda sir would be joining in 5 minutes if that's fine, sir.
Yes. We are
Perfectly fine.
eager to hear him. So I think should we continue with this or should we wait?
No, you can continue, sir, but he'll be joining in within like 2 minutes, and I'll just inform you if he has joined.
Okay.
So,
Okay.
Ankit ji, I have a suggestion if you agree with the same. So, since Nanda sir will be joining in next 5 minutes, so we can continue with the previous part and we can, test the policy of earning per share for the test of materiality. And then in that case, if he joins, then we'll start this section after that deliberation.
Okay. So
because otherwise it will break the flow of this
exactly.
particular part.
That's why I was a little So I am saying, should I open the annual report and look
Yes,
look
yes,
at the
yes, yes,
EPS policy?
yes, sir.
Just a minute.
Because it is something where it is a very common accounting policy which is there in almost every company's annual report.
Right. I got your point.
So,
Give me a minute.
sure, sir.
Sir, there is one query.
Okay, let's solve that.
Should I speak?
Yes,
Uh,
please.
Sir, Sachin Kumar from Mumbai, he is saying, but how do you impair an FD even if the credit rating of the bank goes down?
So it is impaired based on the expected credit loss. Uh, Sachin, we can, open while after Mr. Nanda deliberates, I'll open the PSP projects report also. NAFRA has given an advisory. How how do you impair any financial instrument? It is based on, the same methodology. Whether you impair a trade receivable or you impair a fixed deposit or even you impair any other financial contractual asset, the methodology is based on, if you are using the simplified approach or you are using the expected credit loss method or the lifetime method, there are only two methods which are given.
Yes, so for specifically when we talk about like bank deposits and all, so you can use the simplified approach for this, and it is not necessarily that you need to impair it. But the main intent of NAFRA giving that advisory or order was that you need to test it for impairment purpose because it is a financial asset. Yesterday, Ankit, I was deliberating and I was having a session with a PSU bank. The whole financial and corporate reporting team was there, and I asked the same question whether you think that FDR is a financial asset. The answer was yes, and surprisingly, when I think Nanda sir has joined.
Okay.
Good evening, sir.
Good
Welcome.
evening, sir.
Good evening, sir.
Very good evening. Very good evening. How are you?
Perfectly fine.
All
Sir.
well, we are eager to hear you, sir.
Great.
We were waiting for you only.
Great.
I welcome CA Charanjit Singh Nanda,
I'm
sir.
very sorry I couldn't.
Welcome, sir.
Please, Ramni. Thank you.
I welcome CA Charanjit Singh Nanda, sir, who is very renowned personality that we all know. And he's one of the most knowledgeable person I have ever met. And I always feel motivated by attending your session, sir. Welcome, sir. And I request, sir, to share few words with us.
Thank you. Speakers of the day, Mr. Ankit Maheshwari, Mr. Kothari, Mr. Animesh Singh from the board, and Mr. Ashok from the technical team, and the entire gathering which have come here to go home enlightened. Ladies and gentlemen, my first unconditional apologies because I was traveling from Bhopal to Delhi. We had a national conference in Bhopal where I was speaking on the taxation of securities, shares and securities. That was a huge program with more than 750 members here. So when the program was to start, at that time I was in the flight, but I said that I would speak after the first speaker, Mr. Ankit Maheshwari ends. LODR is a very important aspect, and I want to tell you that coinciding with this program, SEBI has made an expert group constituting of certain professionals to advise them on LODR related issues, ease of doing business, and have appointed me as a member of the expert committee group. So, ladies and gentlemen, ultimately, as chartered accountants, we have to ensure that our regulatory practice is at the highest level. We are unfortunately focusing on traditional practices. We should do traditional practices, but there are a lot of opportunities now in non-traditional fields. At least young chartered accountants who have experience of more than 5 years to 7 years should get involved into these areas. Consulting, regulatory, even appearance before STAT, because chartered accountant can appear before any tribunal. So largely these areas would empower us and would ensure that the society showcases chartered accountants as full business consultant and total solution provider. Ladies and gentlemen, listing obligations and disclosure requirements ultimately is an area where you are able to effectively gauge in how transparency has to be brought in board. I am also the chairman of Digital Accounting and Assurance Board, And let me tell you, on the insistence of the chairman SEBI, we have prepared a guidance note on digital verification. It means that any item of balance sheet or profit loss account can be independently verified except two things. One is depreciation and other is the employee benefits. If I want to look at the turnover, I can go and verify from the GST terminal portal. If I want to verify my export obligations, I can go to DGFT portal. If I want to look at my export obligations, I can go and look at the various. If I want to look at my employees, I can go to PF. So there are so many issues where chartered accountants can give value-added services. So I'm thankful to both the speakers who were kind enough to come and address and put into the right parlance the thought process of working more importantly with respect to LODR and at the same time certain regulatory compliances which are very pertinent for a chartered accountant. And I want to tell you, somebody asked me in Bhopal, Mr. Nanda, we do so much, but still the society doesn't consider us. So I answered by way of a couplet which said, तारीफ की चाहत तो नाकाम लोगों की फितरत है, तारीफ की चाहत तो नाकाम लोगों की फितरत है, काबिल लोगों के तो दुश्मन भी कायल होते हैं. We are from that caste, that clan, that profession, where the bitterest of enemies also acknowledge our contribution. So, ladies and gentlemen, thanks a lot. I am truly honored to be amongst you. Please, and sorry to the honorable speaker, Mr. Kothari, that I intruded in your time, but still I couldn't stop myself from addressing you all.
so much,
Please
sir.
carry on. Always there. Wish you very great luck. Thank you. Thanks a lot.
Thank you, sir, for such valuable words. Now I request CA Kuldeep sir and Ankit sir to continue the session, sir.
Sir, thank you so much for, very quickly motivating us, and not at all, sir. No sorries, nothing. We always are eager. We all have been your students at some point in time.
Yes.
So we are
Yes.
blessed.
Sir, Ankit ji, have you heard that story of X and all, which sir used to tell when we were students? It was a very
Thanks a lot for
popular
your kind
one.
word. Thank you.
Thank you, sir.
Okay, so Kuldeep ji, I have fortunately I've opened this Infosys EPS thing, right? I'm sharing it. You can start, reading the policy, and then we move on the next aspects of it.
So this accounting policy says that basic earning equity per share is computed by dividing the net profit attributable to the equity shareholders of the company by the weighted average number of equity shares outstanding during the period. I think it is till this line, it is the same which is given in
The
the
reproduction of India.
reproduction
It
of
is
the
again a
Indians.
reproduction of India.
Diluted earning per share is computed by dividing the net profit attributable to the equity holders of the company by the weighted average number of shares considered, deriving basic earnings per share and also the weighted average number of shares of equity shares that could have been issued upon conversion of all dilutive potential equity shares. So Ankit ji, without reading the whole text, because it is a mere reproduction of the
It is
Indian
exactly.
language. So if you test this policy on the test of materiality which we have derived, first question is whether it is material or whether omission or misstatement of the same can influence the decision of stakeholders of the company or the general purpose stakeholders of the company. The answer is yes. But when you test it for the other parameters of the materiality, there is nothing as such specific, complex, no judgment or estimate which is being involved in this particular part, no option which is being given in the India's out of 2 or 3 options they have adopted. It is mere reproduction of the India's language, and the production of the same data in the financial statement suffices to be sufficient information.
It is sufficient.
Hence,
You mention the basic and diluted EPS,
yes,
the calculations, and that is sufficient.
and hence
And-
when you see
And the reconciliation would
yes,
come.
exactly. So the amendment in the India says that if it is material, then you need to test it for the 5 parameters that we have discussed, and then if the first it is material and then any of the parameters the answer is yes, then you need to disclose the same. So first only one parameter is saying yes, it is material, but on all other parameters it is not passing the test of materiality. And the second main part is that the information which is given as other financial information in notes to account, it is self-explanatory. Hence, for both reasons, the accounting policy per se from after the implementation of these amendments will not be a material accounting policy, and it is not required to be disclosed along with the financial statement. Am I right,
Correct.
Ankit ji, or anything else you
Correct.
want to?
Correct. No. I think sufficiently, Ravneet. I think we have deliberated on few policies, and the idea is again around the investor relation matrix. So that's now the you will see a significant reduction on the financial section of the annual reports, making it more convenient for users to read. Rather, we being technical people even do not understand sometimes the nitty-gritties or what is an exact reproduction of an index. So expect the user who comes from all kinds of background might not have relevant unless you have a significant estimate or an option involved. So I think over we will now conclude this, and I would want to now Kuldeep ji, let's deliberate on the
Yes, yes.
other parts of the
Other
annual
parts.
report, be it the chairman's speech, be it the MDA, and we will cover integrated reporting in detail. Uh, and how effectively they can help us to communicate to the investor community.
Yes, yes. We are covering that investor presentation also. Need to be specific. We'll have
Okay,
a
yes,
specific
right,
deliberation.
right. I'll download it. I'll download maybe let's download it for Vedanta only, and
Hmm.
the last quarter or any quarter presentation. But let's first look into the annual part, then go on the
Hmm.
quarterly, then the integrated part, and then finally the LODR, which you are the expert of.
अरे नहीं नहीं sir.
Okay, let's now look into uh, 4 5 commonly found things which we found that an investor expects you to put in an annual report. So when you look at the chairman's speech or the director's report, right? So sometimes we see the vision mission statements coming in a very generic way, or they are missing. So they are a commonly found problem with an annual report where even while you look into the transcripts of AGMs and quarterly presentations, investors are clearly asking for three, four things. One, what is your next 5 year plan? And even SEBI LODR guideline asks you to, put some numbers, not the projected number, but the current year numbers. Your EBITDA, your current year EBITDA should be a part of your chairman's speech in an annual report or maybe in an AGM. Or, you have to put the plan, 5 year clear plan in your chairman's speech, and a very crisp vision and mission statement is something which investor is expecting when you prepare an annual report. So sometimes as finance professionals, we need to sensitize this chairman desk. It is merely not excellent reporting practice or merely not a requirement, but at certain stage you will find LODR mandating these things in their circulars that come out with the current year annual numbers or something like that. So that's one part. The other part is the management discussion and analysis, where I think this is a very critical portion
Very critical.
for a investor relationship point of view. When we look into a MDA part, I think 4 5 things are MDA has a very specific format. Kuldeep ji, please.
Ankit ji, before we start with this MDA section, let's put a question before the house that whether it is required to be given as per any statute backed guidelines, or it is compulsory or mandatory or a voluntary thing which companies are disclosing. I'm
So
talking
is
about
it
MDA.
so I am I'll reiterate the topic, right? Investor relation matrix important or compliant? MDA is important or compliant or a part of a compliance which you are making. Let's look for some answers.
Yes.
Do we have any
Any
answers?
answers from me?
No, sir. No.
Okay, Kuldeepji, in meantime, whether it's a part of statute, I'll put it on hold. But
Hmm.
let's talk about what ideally constitutes a management discussion and
MDA
analysis, right?
section.
And what does then whether it comes from statute or our opinion, that's something which we will come out. Yes, Ravneet.
Sir, there is one answer. Sumit Jain is saying that it is important.
Okay. So he doesn't think
Interesting.
that it is a part of compliance.
Compliance. Interesting.
He has just answered important.
इम्पोर्टेंट तो देखो जो कंप्लाइंस है वो तो इम्पोर्टेंट है ही है ना,
Hmm.
लेकिन जो इम्पोर्टेंट है जरूरी नहीं है वो कंप्लाइंस हो,
Compliance. हो.
राइट? सो कुलदीप जी, can you put throw more light on whether it is a compliance thing or whether it is a important thing?
Ankit ji, to be very precise, it is an statute-backed requirement which is required to be given. If you want to write it down for the audience, it is given under LODR Regulation 34(2)E, which states that a management discussion analysis should form part of the annual report, which the companies are required to publish at the end of each reporting period. And there are many disclosures, such as if you talk about Ankit ji, ratio analysis, even if before it came into the Schedule 3 amendments in 2021, there was a requirement of giving 7 odd ratios in the MDA section, and the
Correct,
variance
correct,
requirement
correct.
of 25% was also there. And if you remember
And
correctly,
SEBI
yes,
has slapped lot of fines for company not disclosing the variation of more reason for variation of more than 25%.
so there is a very detailed format, and the requisite details which are required to be given has been mentioned by the SEBI in LODR Regulation 34(2)E. I'm repeating 34(2)E, and it is in all cases. So Ankit ji, it is MDA section is very interesting if you talk about from the perspective of a research analyst or an investor analyst or any institutional analyst. When we talk to them or when we discuss with them, if you remember the last week's incidents, they say that as of now they are looking at only two parts of an annual report. First, for business perspective, business outlook, they see the MDA section, and then they go on to the financial statement section. So the
Correct,
importance
correct,
of MDA section is says that it can change the perspective of companies approach or companies image in the mind of a stakeholder. So it is an compliance which is required to be done as per SEBI LODR regulation, as well as from the perspective of investor relations also, it is very important. For the perspective of communication also, it is very important. So from the next time onwards, when you see or when you draft or when you advise on MDA section, you need to see it very carefully. Over to you, Ankit ji.
Done. So all one thing, all I want to add from here is that after integrated reporting framework, the MDAs in this country has been compromised. Please, my dear friends, integrated reporting is a voluntary framework, number one, right? Yes, we are benchmarking it to IIRC guidelines. Interestingly, I was looking at we both were reviewing a report in which the MDA section says the heading of MDA section is MDA and financial capital. Now, what correlationship it has, I am still unable to understand. So IR teams now needs to be, more robust about what they're doing after integrated reporting framework coming up, because there is a possibility of repetition of information for which you can cross reference. Something which do not comes as a part of integrated reporting will not impose a fine to you. But something which is not a constituent to MDA, say a enterprise risk management policy, say your human resource policy. So while you write human resource capital, in integrated reporting, you obviously disclose the entire HR policy, right? And that is why you choose not to write it in MDA. And when you choose not to write it in MDA, that's where the problem begins. It's a mandatory thing. You have to mention your HR policy. You have to mention your internal control framework. You have to mention the health and safety thing. So all these things are part of your MDA. Now, the other thing is, so this is minimum requirement. While we talk about the best practices, then the ERM frameworks has to be benchmarked to ERM 2017 or the COSO frameworks, which we have been talking about. The internal control policies and everything, the kind of risk you see needs to be clearly mentioned out. The risk, the ways you mitigate those risks also becomes a part to this. Similarly, your CSR and everything, they all become a part to this MDA section, right? As I told you, they can be conflicting with higher integrated reporting, but don't compromise your MDA for integrating reporting. That is one thing which I want to put up to. The next is the corporate governance section. And in this, while we will discuss the compliance of LODR latest amendment with respect to corporate governance also, here I am only talking about few things which we find that are missing in while we put this annual report in front of investors. One, I think, very interesting fact which Kuldeep ji only cited in one of the service providers industry, that the directors of the company were not attending the audit committee meeting. The audit committee chairman was not attending, or some independent director
This independent
was
director was not attending the meetings.
right.
In one
So
case, the
out of
chairman.
three out of three out of four meetings were missed, and in case there is a substantial non-attendance, then the reasons for such non-attendance needs to be disclosed as a part of good corporate governance practice, right? Uh, in certain cases, the impact of the social security code, the new social security code, the new labor code, these are forward-looking practices. They are important. I am repeating it, but not complying to them does not impose a penalty. They are a good practice. Similarly, the corporate governance disclosure, the related party transactions, everything, the constituents of the corporate governance report. But I am pointing out one or two points in each section, just requesting the audience to be meticulously working on both financial as well as non-financial section. Anything you want to add up, Kuldeep ji, in corporate governance?
Ankit, I just want to say the irony is such because since people consider it as in compliance for the purpose of doing compliance, so the thrust of Indian reporting fraternity per se companies or from consultant side is always on the financial statement section. And in this pursuit of disclosing or working on the financial statement section, we miss out on giving qualitative and good information in the non-financial section. Like you spoke about that non-attendance of a board meeting by director or independent director. In one case, if you remember, it was a very big insurance company in which the chairman itself didn't attended the AGM and few other meetings. And when asked upon Ravneet, they said that kahin likha hua hi nahi hai. If it is not written somewhere, and hence it is not a non-compliance, and hence we are not going to disclose the same. And the problem lies here is that when we see the secretarial audit report also, in all listed company, you will see that the company secretaries are signing that we are complying with the requirements of SS1 and SS2. But when you see that SS1 and SS2, the requirements are very vast, and you will see in many cases, the secretarial standard requirements are not being complied with. It is also, when you talk about excellence in financial reporting, you can see standard setting with the benchmarking of accounting standard, Indian accounting standards, or Institute of Chartered Accountants of India. But when you talk about secretarial compliance, you can see benchmarking or standard setting from the perspective of ICSI also. And it is given in the secretarial standard itself, that if it is a major non-attendance, I'm not repeating, but I'm just putting emphasis on the very small point. If it is not a major if it is a major non-attendance, it is required to be reported along with the reason, because every committee which has been constituted, and if you see that in all CG reports, Ravneet and Ankit, you will appreciate that in all CG reports, you will see that the committee composition, who is the director who is part of that committee, the information about chairman,
the vast experiences of directors coming up.
Yes, everything is being reported because it is given in the statute that you need to give the composition, the meeting details of every committee per se. But since it is not written in the statute explicitly that if no attendance is being done by any director, we are not going to report the same. So this is all about reporting above par, because there is a very thin line of difference between reporting at par and reporting in excellence, because the topic of today is investor relationship metrics, and the way of investor relationship metrics paves through the annual report only. So
So,
if
so Kuldeep ji, I'll just,
Hmm.
conclude your thought. Uh, while we say important, that means itself that we have to report above par at excellent practice.
Exactly agree.
Compliance is a minimal thing which we are expected to do, right? With financial disclosure, I think Kuldeep ji, we have given enough thrust and we've
Yes,
discussed various policies.
Hmm.
One commonly found thing, I think even we are as it is reproducing Ind AS, there are still mistakes. For example, while disclose and this time when we came out with the compendium of Ind AS, I and Kuldeep ji only authored that compendium of behalf of the research committee of the institute. This compendium came on 1st July. You will find all industry problems coming there, and the financial disclosure you can find it out. But few critical things I can talk about which I feel have been we should look into. One, Kuldeep ji, the KMP remuneration, the way of
Yes,
disclosure of
yes.
KMP remuneration, even Big Four being the auditor, the companies being the largest listed companies of the country, they are not able to disclose their related party transaction properly in financial disclosure section. The remuneration, there is a way methodology to provide the KMP remuneration. When you look at the Ind AS, the directors, even the remuneration paid to independent directors comes under the KMP remuneration and needs to be disclosed under the related party remuneration. Similarly, we discussed the financial instrument policy, we discussed the trade receivable policy, you know, uh, we discussed while Kuldeep ji, you would, all while we were discussing Ind AS 109 and we were discussing the credit risk and interest rate risk and, the market risk. So, all these risks are not properly disclosed or they are not, there's no sensitivity analysis which has been missing in all these Ind AS 107, which is the financial risk management Ind AS. So all these things needs to be in order as chartered accountants. When you are communicating to uh, industry, the first basic thing which is expected is a proper financial disclosure to your investor. As CAs, we play a very vital role there. I feel very bad, Kuldeep ji, in saying on this forum that when FRRB conducts a review or when NAFRA conducts a review, you can see the quantum of debarment NAFRA and FRRB is
Too
doing.
much.
And Ravneet and Kuldeep ji, this debarment is not fraud. This debarment is not embezzlement. It is a deviation from a financial, from an Ind AS. It is a deviation from a standard of auditing. And earlier, industry peoples were not suspectable to it. Now even industry people are taken care after our charter revised code of ethics was revised and the applicability of no clar clause came. So my point here is a financial disclosure is a quintessential thing and it cannot be compromised from the auditor side also and from the CAs who are working in the corporate reporting teams. When we barely look at the index, I am telling you, we find some serious non-compliances. FRRB in 106 reports they reviewed, Kuldeep ji, they have found 90% reports to be non-compliant. Please visit FRRB site. You will find where the problem stands. And please be afraid of NFRA and all these regulators coming while you are doing the attestation function or even preparing the books. That is all I can say. Kuldeep ji, ये तो बहुत we are deliberating on very high
Yes,
standard
yes.
things. Ravneet, when you look at FRRB reports, you know what kind of allegations are there. The cash flow statement is stated as the statement of cash flow is stated as cash flow statement. FRRB ने ऐसी observations दी है.
इवन अंकित जी आपको वे केस इफ यू रिमेम्बर जिसमें कैश फ्लो स्टेटमेंट के अंदर दे आर स्टिल यूजिंग द वर्ड फिक्स्ड असेट्स
Fixed assets.
दैट इज वेरी 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 मिनिस्कल
Basic
बट इट इज
things.
वेरी इंपॉर्टेंट
So I think if you are doing an attestation function, look for an upgradation. You can't do an attestation function before you upgrade from with the newest standards. That is all I want to say on it. Because the topic is on investor relationship, I don't want to entirely stick to the technical standard. Kuldeep ji, anything you want to add up into annual
नहीं
report pitfalls?
नहीं, I think we
So,
have covered sufficiently.
right. So if you want to communicate with your investor in a better way, I think there are these few initiatives which you should start taking in your annual report. A recommendation from three of us, I, Kuldeep ji and Ravneet, is that look into the AR/VR report of Tata Steels. The annual reports have gone on another level. You see a complete simulation of an entire journey of Tata Steels while you look into the AR/VR report of the annual reports. That means the next era would be of digitization, and how quickly you digitize it. You might see in times to come, all these 500, 600 pages report will not be there. There might be only the video recording and some documents coming up. But must see something which I would, go ahead and look at it. You will realize why these companies are Tatas and why Tatas are Tatas. So that's one thing. The second is the interactiveness in the report. And Kuldeep ji, the insurance company you were talking about, I like that, the theme-based reporting they do. So they
Because
do reporting on, last year report was on IPL theme, no, Bollywood theme.
Bollywood theme.
This year report they have come out with IPL theme.
Have you
So
have you seen any annual report being sold on Amazon, Ravneet? Because Ankit ji and we are aware of this fact, but have you seen any annual report being sold on Amazon?
so people,
Um,
before Ravneet answers this, Ravneet, I'll tell you interestingly. I was with the chairman of a very big listed company, right?
right.
And I tried to invite him for the session also. I am sure he must be listening if he might be there. And I told him he's a chartered accountant and a top chairman. He said, "Hey, who reads these annual reports? I don't read it. We are in an era where the chairman of the company doesn't read it. And now this company, this insurance company, has sold 3,900 copies of 3,900, correct,
Yes,
Kuldeep ji?
3,900 to be precise.
Of annual report on Amazon.
No, sir, I have not seen.
So all the costs they have incurred on us, they have recovered it
So
from
selling on
selling of
Amazon.
that annual report. And because people look forward, so that's what an interactiveness can do. And that's what I told to this chairman that the report, our report is so boring. Nobody wants to read it. Your investor, so you have to capture investor interest by multiple ways.
Right.
Not necessarily, you have great numbers to do, you have great plans, you have everything in order, best of the corporate governance. But if your communication is boring, expect your investors to stay away out of
Yes.
such companies. We are into a digital era. Importantly, cross-referencing, and I and Kuldeep ji were consulting a very big media house, and
I
very
was.
happy and proud to say, not because of
Yes,
our
yes.
suggestion, but because of their will only, that
Super.
they referenced their entire financial disclosures. Entire financial disclosure were referenced. So a report has to be easy to navigate. This is important. I am not talking of compliance. Compliance we have talked about. Important part of annual reports is we are talking on, right?
Mm.
More transparent, more focused on materiality, more focused on sustainability. From next year, we see sustainability audits also happening. Even the quarterly communication should have lot of information about your sustainability. And after this, Kuldeep ji, we will open the I felt that Vedanta sustainability is report is also good, and their report can be looked into the
Right.
quarterly. So let's look into that report, and what changes do we see in a quarterly presentation. We will see that. Today's era, we will talk integrated reporting, right? We see enhanced disclosures, more material disclosures coming up. So we are in a very tricky era where the disclosure is expected to be enhanced, but at a shorter length, but at a relevant length, not obscuring uh, the financial information which this company wants to disseminate through its notes to accounts and policy. So with this, we conclude the annual report section. If there are any questions on annual report section, we are more than happy to take these questions. Else, Kuldeep ji, okay, Ravneet, please.
Sir Sumit Jain from Jaipur, which insurance company? He has asked which insurance.
Future generally.
Future General Insurance.
Okay. And next, someone has given his view that more AR and VR reports using AI will be the future.
Absolutely, sir.
It is going to
You
be the
are you are correct. The redundant reports will not be there, and that is why we are discussing in context of an investor relationship. As CAs, we need to tell these forward-looking approaches to the companies we are working for and helping them to, communicate with their investors. Correct. So, Kuldeep ji, let's Vedanta
Let's
is
move
the
on to
company because they
Yes.
have good sustainability reporting
Hmm.
also.
Hmm.
And let's look into their quarterly presentation. No opinions on anything. Please don't take it like that. Right. Every company has a problem, and every company has some positive sides. And when we say the problems, positive sides, and the negative sides, Kuldeep ji, I think the first topic which I would want to take with the quarterly presentation is headwinds and tailwinds.
Tailwinds.
And to all the learned audience who are willing to communicate through a quarterly investor presentation, two questions to you. One, is an investor presentation or an earning presentation or a quarterly presentation mandatory thing? Two, what do you understand by a headwind and a tailwind in an investor presentation? Two questions, Ravneet. Look for answers.
Yes.
Is an investor presentation mandatory? I can name few companies who are not uploading investor presentations, and we have been deliberating and we have got very interesting answers. Yesterday only Kuldeep ji was deliberating in a session. I had a morning discussion with him before this session. He said, he gave a very contradictory answer to what we think. And the second is, what do you understand by a headwind or a tailwind in a investor presentation? Till that time, allow me to download. Kuldeep ji, you deliberate on these answers. I have not downloaded it. It will take me few minutes to do that.
Any answers, Ravneet?
Not still, sir. No.
So we can wait for, I think, 10-20 seconds or so, because there may be a
वेट
time
तो
lapse.
करना ही पड़ेगा क्योंकि मैं डाउनलोड कर रहा हूँ. आपने एक नया एजेंडा दिया तो लेट्स टेक इट एंड इट्स एन इंटरेस्टिंग थिंग.
Yes, sir. It is an interesting thing. So before you download, start. If nobody answers, can I answer it for the
Sure.
audience?
Sir, one person has answered. Preeti, I feel replicating the text of Ind AS is not useful in understanding the report. The report should be in a language that depicts the situation correctly.
That was related to, I think, that material accounting policy part which we discussed earlier. But no answers related to this, Ravneet,
sir.
about
No,
this
sir.
investor presentation.
No, sir.
So very interestingly, you will appreciate this fact that when Ankitji, I was deliberating in yesterday's
Right.
session, I asked this question from the top management of a bank, that whether investor presentation is compulsory or not. So the answer
Correct.
of all persons, including the compliance officer, the CFO, or the other KMPs, were the same, that yes, it is important and it is compulsory. So then again, I ask a follow-up question, by which regulation it is compulsory. Then they said that नहीं हम लोग report कर रहे हैं इसके लिए compulsory है, because since last 2 years previously we were not doing, since it is compulsory. So I was very happy, Ravneet, to listen to them, Ankit ji, because we were discussing and we were trying to find out a way. See, we are deliberating here, that is one part, but on another part we are professionals also, and we always look for work also. So if it is compulsory from company's part, our work will increase like 10x, 20x. So I asked them that they told me they had the session today morning also. They told me that I'll get back to you tomorrow morning. So whether it is compulsory or not, सुबह जाते ही मैंने उनसे क्वेश्चन पूछा, मैंने कहा कि सर whether it is compulsory or not, तो थोड़ा सा मुतरा हुआ था, मैंने कहा क्या हुआ, बोला नहीं नहीं सर इट इज नॉट कंपल्सरी। मैंने कहा यार वी आर आल्सो ट्राइंग टू फाइंड द सेम आंसर। सो फ्रॉम द पर्सपेक्टिव वेदर इट इज इम्पोर्टेंट और compliance, it is important but it is not a compliance.
Sir, one answer was
Yes,
there.
yes.
Sumit Jain from Jaipur, he has answered that yes, it is mandatory. Headwind means positive expectation and tailwind means negative side. Sir has asked, na, I think.
Ankit ji, is it right?
You answer it. I am looking at the presentation, but I think with the headwinds and tailwinds, he has just gone opposite.
Yes, yes, exactly. That is what I was thinking, but is it right
But-
that it is mandatory? Sumit ji, can you
So-
answer it for us? Under which regulation it is mandatory? We are looking for this, particular answers in so many
No, so
months.
I will also deliberate. I am just, into the investor presentation thing. I'll come back. But I sometimes feel, Kuldeep ji, it is mandatory. Sometimes
It
I
is
feel
mandatory.
it's a feeling.
It's a feeling. Actually, what happens is that in many places, in LODR, if you see Ravneet and Ankit ji, it is written that if any specific event which has happened in the quarter, if there is any material information or material transaction which is required to be explained to the entity, if any, like say, any they are coming with up any QIP or any fundraising plans like NCDs and all, or any other specific event, in that case, they are required to give an investor presentation or they are required to hold an investor meet. But it is not specifically mentioned and it is not compulsory from any perspective. Investor representation is basically the intent of investor presentation is to communicate the idea, communicate the investment case, which Ankit ji will deliberate later on to the stakeholders, because you need to have a very healthy and transparent communication with the investors. See, what we see in an quarterly result, Ankit ji, you will see that a precise format in which the results are being disclosed. Every listed company is giving results on quarterly basis. An ALR report is being enclosed with those results. And this, suffices for the SEBI requirement, which is required to be done for the quarterly results. But if, as an investor, Ravneet, if you appreciate the fact, if you are invested into, say, Vedanta, so whether you will be able to dissect and know each and every part on each and every aspect or each and every reason for which you should remain invested into Vedanta, or you should invest into Vedanta by looking at the results, my answer will be no. I think what will be your answer? Whether you will be able to dissect each and every part by looking at the quarterly results, or you will seek for further information, or you will like to have a deliberated investor call, you would like to attend an investor con call.
Sir, I will go for other like investor call, or I will see other aspects also, not only quarterly results.
Kuldeep ji, you are
Because-
having limited audience to answer. So this is not good to the moderator. So I think the logic is very clear.
Sir, one answer was there. Sumit Jain, I think he was saying that should be under SEBI LODR.
It
No,
is.
so that's what Sumit, I think Kuldeep यही बोलना चाह रहे हैं, right? And you come from Jaipur, I also come from Jaipur. We can, after the session have a quick deliberation again. But my point here is that he is trying to say that there is no strict mandate of putting up an earnings presentation. But there are certain cases where you are expected to, communicate with your
expected to communicate.
stakeholder quarterly if certain events takes place. So in general, with large conglomerate, these events are common events, and that is why they prefer going with a compulsory investor presentation so that the critical aspects are not missed. I have Kuldeep ji opened the last
yes,
Vedanta's presentation. It's a wonderful presentation which they had made, right? However, let's look into the constituents and we will look into the scope of improvement, not with an idea,
It is not
if we find something, right? So an investor presentation is divided into two aspects. One, what the group CEO presents. Also, Kuldeep ji have started using in his PowerPoint presentations also. And this is for this company also, that there's a cautionary statement which we are coming out, right? That it is not a opinion that, based on it you invest or don't invest. We are understanding only the nitty-gritties of the presentation, the positives and negatives of it, right? So when you look into the earning presentation, it is divided into two parts. One, the business performance, which the group CEO gives, and that's a standard practice. And one, the financial performance, which the group CFO gives. Okay. So with business performance, the first thing, now there is no, no standard coming up. Like an annual report, you find a chairman's speech to MDA to, sustainability report, everything comes in a order and maximum companies comply to that order. There is no order for an investor presentation. The only standard practice is the business performance and the financial performance, which these companies gives for. Vedanta, being a mining company, would always prefer talking, and a global player of Vedanta size would always prefer talking about their sustainability goals, because mining companies have the susceptibility to sustainability. And everybody is very keen about, since they use the natural resources of the country, as to how they are regrowing the natural resources. So ideally, Vedanta's presentation should talk about sustainability, and that's what it happens, right? That's what it happens. They have talked about their ESG goals. They have talked about, on all three fronts of environment, social, and governance, right? Uh, it's a great number which they have come up with. If you look at the number, that's a number which everybody is looking at also. But then how they are going on their ESG goals is another thing. So the idea they are projecting up with the carbon neutrality, or the decarbonization, or how they are uplifting the lives of their workers, their families. So you see different ESG goals. Positive part, I think, Kuldeep ji, I like the positive part as to, they have taken a baseline, they have taken a target, and they are updating their investor as to where they are reaching on the front of ESG, right? So there are 9 fronts to it. I don't know why only 6 are here, but with aligning yourself to ESG goals, there are 9 fronts to it, right? But you can come up with most specific information. Not necessarily that an investor presentation should always talk about the rosy things. What I did not liked about this presentation is that they are talking about the rosy things only, the things which have been nice on ESG front. Your investor might want to know something out of this sustainability which you are not able to achieve, and the reasons for it. So that could be one thing which which can come up, right? Uh, the next is the roadmap of going net zero carbon, and I like this waterfall chart. This can be presented in a better way, in a more simpler way also. This looks a little complex, but my point here will be, yes, I am happy that they're talking about how they are reaching to the net zero carbon thing. Kuldeep ji, anything you want to add up to
I
this?
just wanted to say that it looks little bit cluttered also, because it is, you can say that it is like obscuring of information, like we were talking about in material accounting policy. They have given the waterfall chart. It is very good. They are giving their roadmap to net carbon zero by 2050. That is very good. But the way that they have presented, I think that it could have been done in a better way, with a little bit of graphics involved into it. So it is easy for, see, if we are professional, it is difficult for us to understand how it will be easy for an investor, a journal investor, to understand the same. So the intent of an investor presentation should be that it is easily understandable and readable for the journal users of financial statement, or journal users of this investor presentation.
Okay, so noted. And also, Kuldeep ji, while I think to my understanding, when an investor presentation starts, we should always talk about the investment case.
Yes, investment case.
And most of the companies, doesn't quickly change their investment case. This presentation, maybe on the later part, might have investment case, but to our suggestion, Kuldeep ji, you would want to always get an investment case on top of it if you're looking
Yes,
for
yes,
investor.
because that is why I am giving an other than all the objectives that we are discussing or we will discuss, what is the
Mhm.
ultimate objective? Ultimate objective is to create a connect with the investor and to make your company's image good in the mind of the investors and to have your company's share price moving in the right direction.
Right.
But
Right,
on the
right.
basis of good reporting, transparent reporting, and good corporate governance, and without giving a clear investment case as to why should I invest into your company or why should I remain invested into your company, like
Should I
Ramneet, we
should I
discussed.
should I check
Yeah.
whether they have an investment case so that we can
Yes,
open that
we can
slide
check.
itself?
We can check.
I don't find an investment case coming up, Kuldeep ji. Sorry.
Because
There
as
has to be an
Ankit,
investment case,
there has to be. There has to be.
irrespective of whether your report is quarterly or annual.
Yes.
And
Because
it has to be customized. Please don't stick to one investment case.
mm,
Your operations changes, and Kuldeep ji, because they don't have an investment case, but I really found very interesting
mm,
that people talking about subjective investment case.
mm,
Whenever an investment case is backed by some number,
mm,
you will realize that that investment case goes much into the heads of investor.
mm,
Even you have more headwinds,
mm,
or even you have an adverse scenario ahead, you should definitely talk about, your investment case. Because this company's, it's a public data, last quarter might not have been great.
mm.
So they decided to not put up an investment case. This could be a case, or maybe it might be another specific call. The next is operational highlights, and all the segments in which they are working. I think it goes fair enough, right? I like they're now here talking about what has been lower and what has been on the higher side, right? When the numbers are very high, please don't start talking too optimistically in your investor presentation. Otherwise, your investor expectations increases in next quarter. So today, if you think that you have done a very good number, I was with that company's chairman Kuldeep ji I was talking about, है ना? He said that we did worst numbers. मैंने इतना खराब quarter कभी देखा ही नहीं. So I said, when you have done that kind of a number, so बोले, but I want to speak to my shareholders that this is our worst quarter. So that, है ना, tomorrow in next quarter, he doesn't comes up, right, with a lot of expectation. He has already set the tone in the beginning of the year that now we can't compensate this in next 3 quarters also. The number has gone down to that kind of a level. So be very transparent when you present these highlights, right? A shareholder might be disappointed in a shorter duration, but he looks to stay invested in your company. And that's another reason for an investment
Like
case.
one observation which I can figure out from this particular slide, Ankit, is that yes, they are giving operational highlights and other highlights. It is very good, but can you see that they are giving, at some places they have given year-on-year numbers, and at some places they have given quarter-on-quarter numbers. So it can be a case because the one which suits the company is giving or presenting the same, but ideally it should be one single criteria or one single benchmarking should be used. If you are using year on year, then you should give year on year, or if you are using both, then you should give both, because like Ankit ji has said, if there is anything which is not good for the company, which is against the winds, then it should be disclosed, because it may be the worst or it may be something which the investors are really interested in knowing.
Correct.
The very basic purpose of investor presentation is they should know about both positives and negatives. So
Absolutely.
then an investor can make an informed decision that whether I should be invested in this company or whether should I invest in this company or no.
So Then they have their segmental story coming up, right? And also make your investors presentations very dynamic. The companies you are consulting, I and Kuldeep, you always try that, we bring lot of dynamism while we are advising them. Every time you can't come up with the same story. So naturally, there has to be a synchronization. And this company talks about, uh, uh, the highlights or the positive sides of all the segments. Sometimes, I would say, because the quarter was bad, Kuldeepji, one suggestion, they should have come up with headwinds.
Yes, you had Vincent and both.
The headwind slide is missing, right?
Mhm.
Now comes the financial presentation, which is the earning update and which is more relevant to us, right?
Mhm.
The numbers which are coming. Kuldeepji, I see no comparisons here, right? So the revenue has gone up or down, right? Something comparatively should have come. What do you say?
It should be there in the
How do you know
page.
that the performance, Ravneet, how
Uh,
do you know that the performance is good or bad? It looks good, but I am telling you, it's a public data. It's a bad quarter for every company in this country. This has been a very bad. The last quarter has been very bad. But
It
you
is
don't come to know where the EBITDA
no.
margin has moved. It has moved upwards or downwards. Correct. So I think also when you are, there should be some more financial numbers coming up, Kuldeepji.
Yes, yes, they should be
Right. This is
few
very
ratios
basic.
also.
Okay. Now we have a EBITDA bridge, and some companies use this bridge and some doesn't. This company has a logic of using this bridge. The logic is because they have a lot of market and regulatory intervention, and that is why they have tried to use a EBITDA bridge. EBITDA bridge itself indicates to all the users of an investor presentation. So you have to first rebase your EBITDA. So they are saying our Q4 number was 9,362 crores. But why a bridge? Because of this, because of certain market and regulatory factors. So they have identified three factors into it. One, the prices on London Metal Exchange, right? And the Brent and the premiums which they have been taking, right? What kind of impact? It has an impact of 2,000 crores. So that is now they are rebasing the EBITDA. Then the input commodity inflation and the forex fluctuations, all this is beyond control. If because earlier this was a tailwind for them, so they were able to do a number of 9,360 crore and avoid these tailwinds, exclude these tailwinds. The rebased EBITDA is 7,638 crores. Now, this is sometimes strategically done by these companies. The logic is that, you otherwise you will say the last quarter was 9,362 and today is 6,975. However, those who understand this presentation, they understand the logic of a EBITDA bridge also. Right. Now, this rebased EBITDA to the quarter EBITDA, that this is something which is common. This is a standard practice for all companies, which they have also done correctly. Now they have the idea, they have worked it out very smartly. So the idea of 9,362 to the journey of 6,975, all people will say 30% fall, right? They specifically came out, no, it is not 30% fall, it is just a 9% fall. Kuldeep ji, I missed your voice.
This was the intent, and when you talk about EBITDA bridge, almost all companies which are into natural resources or mining and all like commodity, they tend to give this sort of EBITDA bridge because their commodities or the product in which they are dealing are specifically regulated by the government in some cases, and the prices are also being fixed by the government. So that is the main reason why they are giving. They can divide it into external and controllable factors. This can be a better understanding for the investors that these are the externals on which the company don't have any sort of control, and the other factors are controllable factors which are within the company, which the company can control at their behest.
So Kuldeep ji, an EBITDA bridge needs to be between the last quarter and the previous quarter. That means between the Q4 and the Q1, or between the Q1 and Q1 of the previous year.
See, if you there is no such regulation which is there for this, but basically the companies are giving for the immediate previous quarter.
Immediate previous quarters, right? Now
Immediate previous quarters.
they have interestingly given two EBITDA bridges,
Yes, yes.
which is again an interesting fact.
Interesting fact.
Now company is trying to communicate to the investor that there is still an improvement. However, uh, you can't get away with the facts. So as chartered accountants, we should be very clear about understanding it, that the ideal practice is this only.
The reason behind, I think, giving this particular second EBITDA bridge is that one, the quarter was not good since it is a public data, and the second part is that when you see the presentation format of SEBI results, you need to give that preceding year's same
Okay.
quarter information also.
Okay.
So for that
Okay.
purpose, they are giving this EBITDA bridge
I
so
get
that
it.
the investors can correlate. Maybe
Okay.
this can be the reason.
Okay. Now there is a debt breakdown, right? Kuldeep ji, there's an interest expense and there's an interest income. What is the logic of it?
It has no logic attached to it, according to me.
It
Because
has
it
an
is not
adverse
a-
logic, right? So you are
Yes,
saying
yes.
that I pay an interest at at 8.7%. However, when I have to take some interest, I take it at 6.7%.
And
I
my
don't think
treasury
it should
operations
come
are
up.
not working in line.
It shows treasury inefficiency. Should not come into like that. Rest, I think the net debt to EBITDA is something which needs to be given. The maturity average term debt has to come up. The gross debt, net debt breakup, the foreign. I think the presentational part, you would suggest some, more visual aids into it. This can come more easy, more user friendly. But yes, all these things are important to come. Right.
Have they given that net debt walk?
No.
Is it missing? Very
Yeah.
surprising. If I'm not wrong, Ankit ji, they used to give this net debt walk in every quarter.
They used to give it. Yes. They used to
Very
give it.
surprising.
But I think maybe it's because of some strategic reasons only. Otherwise, companies with all these heavy debt companies, right? They should try giving their net debt walk to give a comfort to the stakeholders, right?
Can you
So-
elaborate a little bit for us that what is a net debt walk and how the company should present the same?
So ideally, a net debt walk is something, a company is projecting as to whether the debt has been increasing or on a decreasing trend, and how the debt has been utilized also. Why Kuldeep ji is saying for a net debt walk? Because we already had a discussion when we were looking at its investor presentation. Ravneet, their net debt walk had payments of dividend in their debt. So you are saying I have raised a debt of X thousand crores, out of which there's a dividend which the company has paid. So that is why a net debt walk is important, because your lender also wants to know how you are eventually utilizing your debt and where you are heading. Are you heading to an upward trend, or the debt has to gradually come down? Now, I have no expansion plans. The gray flag could be for a company who has no expansion plans and the debt walk is going higher, clearly indicates that the company's interest cost is not justifiable and company is not able to serve the interest, or company is using their long-term loans, the short-term loans for a long run resources.
Long-run purpose.
So if they are aligned to an expansion plan, it should come, and that is why a debt walk needs to be given, that how much they are aligned to the expansion plans and how much has been used for non-constructive purposes. Kuldeep ji.
Then I agree with you, and the net debt walk ideally should, end with the maturity profile, that how gradually and till what time the debt amount will be zero and it will be repaid in terminal years. So net debt walk should start from the previous quarter, immediate previous quarter, or if it is about a year, then the immediate previous year. Then it should show that what plus and minuses which have been done in the debt profile in the current quarter, and then it should gradually show that how and in how many years the debt is going to be paid off. That is
So
that is the ideal
so
presentation of a net
one
debt
thing,
walk.
if you are a high debt company, go out with your net debt walk.
Yes, we should.
Go out to your stakeholders, tell them what you are doing with the debt, how effectively and robustly you are utilizing it. So I think, Kuldeep ji, then there are standard formats of the annexures. I would not want to discuss too much into it, because we are now left with last 30-40 minutes of the session itself. So we would want to only go into the LODR guidelines first and then the integrated reporting to conclude. What do you suggest?
I think we should take integrated reporting first, if it is.
Okay. So I hope, are there any questions pertaining to investors' presentation?
Let me see. No, sir. Someone has given a suggestion that yes, comparison should be given.
Okay.
I think
It is about the EBITDA bridge.
yes.
Okay. Yes. I think Kuldeep ji also, put that point. So
Yes.
now we are going on an integrated reporting framework from here. I'll very quickly deliberate on where does this integrated reporting framework. But before I deliberate, Kuldeep ji, let us ask what an integrated reporting framework is.
And which was
So,
the first company to come up with the integrated reporting in India?
Okay, two questions, one from me and one from our co-speaker.
I have one more question, which will take us in the SEBI LODR amendment regulation also. The company which was the first company to give integrated reporting in India was the first company to give a certain amended regulation requirement with the stock exchanges. So we have given sufficient hint for the audience. Now it is
Now I know
up
the
to them
answer.
to answer.
Now I know the answer. But you are not asking me. I might go wrong.
Yes. I'm not asking you, neither Ravneet.
Ravneet.
She'll be like that. I am not going to moderate,
We
boss.
need to escape from his knowledge, Ravneet.
Yes.
I am telling you, we sometimes
No,
when
sir.
we deliberate.
I'm enjoying the session.
Okay, I'll come up with the PPT here. Visible?
Yes,
Visible, sir.
visible.
Okay. We will wait for the answer for a minute.
Yes. We should, I guess.
What is an integrated reporting framework? To the answer which I am not sure of, but the question is, which company first prepared the integrated reporting framework? And a hint of it is that while this new regulation came, they were the first one to do a complete compliance with it, right?
A certain amendment, which we'll discuss along with this integrated reporting part.
Okay.
I'm expecting at least few answers. Either Ravneet has to answer them.
Boss, we are on a Saturday evening, so don't expect too many answers.
Not yet, sir.
Okay.
Sir, one answer is there. Tata Steel. 6 capitals, Tata Steel.
Kuldeep ji, so the answer in the shortest way is correct. The integrated reporting has 6 capitals, and and how do we use those six capitals is something we will together discuss. Kuldeep ji, is Tata Steel the right answer?
Not the right answer, sir.
Can there be a group company?
No.
Okay. So I was thinking for a group company, even my answer is wrong.
Not related to Tatas
Okay.
or Ambanis or Adanis.
Okay. Okay.
Because
You go ahead answering it, I think.
Ramneet, you want to answer or
No,
should
sir.
I answer it?
Navneet, किसी भी listed
You
company
should
का एक
answer.
का तो नाम दे ही देते.
So the company which was the first company to come up with the integrated reporting is Kirloskars. Said they were the Kirloskar brothers were the first company in 2013-14
Yes,
to come
yes.
up with
We
the
have the
integrated
case study.
reporting. And Ankit, surprisingly and very interestingly, there is an amendment in SEBI LODR regulations which came up on 14th of June. The regulation 30 and certain other regulations were amended. It requires now a promoter to disclose each and every agreement, each and every discussion, each and every arrangement which has taken place between the promoters, like within the family offices, between the KMPs of the company, between the directors of the company, irrespective of the fact the company is a party to that particular arrangement or agreement. So, meaning which it is a very interesting amendment, Ankitji. And I was looking at a session or you say interview of Mr. Cheryl Shroff on CNBC. Also, he was also of the same opinion that it is a very tricky situation for the promoters because Ankitji, the onus of disclosure of all regulations is on the company itself. And you will appreciate the facts that there are many decisions which take place behind the doors in the chairman's office or at their home. Because if there is any sort of family agreement or settlement is being done, like you and me are brothers and we are running a company, and all of a sudden we decide that the Rajasthan part will be looked after by NKG and the Delhi part will be looked after by me. So it
That
is
is
it has
already
nothing
decided.
Yes. Candidly, I'm telling that it has nothing to do with the company. It is it is understanding between two brothers, two promoters. But now the statute requires you to disclose the same agreement to the exchanges. The company is required to obtain the information from the promoters about the previous transaction. The date was 31st July, so it has passed. Now the company is required to disclose the same to the exchanges well before 31st of August of 2023. So the date for taking information from the KMPs, promoters or family offices of the promoter group has passed. Now the interesting problem or the dilemma here is that how backward and how much deep in past should a company or should a promoter or should a KMP is required to go. Like there can be a family settlement or family agreement which took place in year 1990, which took place in 2000, and the answer is yes, that you need to go back to the past to the extent the information is available. This company, Kirloskar Brothers, was the first company to, upload and push their draft family settlement agreement, which took place between three promoter brothers on the exchanges on 9th of August. So it clearly says that
let
if
me
there is
put
any
the
sort of
slide
family
itself
agreement also.
now. You
Yeah,
discuss
sure.
this in totality, na? Then we will come on integrated.
Yeah. So Kirloskar was the first company to come up with this such sort of disclosure to the exchanges, and when they've uploaded the draft family settlement agreement, and Navneet, you will appreciate the fact, Ankiji, you will also appreciate the fact that this agreement pertains to year 2009. This agreement pertains to year 2009, and this was a news in all prominent business channels also. So how how transparent the entity is, as they have come up with the compliance of the new disclosure requirement upfront. So this problem may seem to be a very common problem or very normal problem in our side, but Ankit, you will appreciate the facts that in South side, there are many listed companies. There is a tendency of having a family charter or family board to run or to decide about these sort of transactions. So, like if we are a family of 5-10 people, we have a family charter or family constitution which is being made, and for each and every decision, the board sits, that the family board sits, and they take a decision. So, after amendment, after implementation of these amendments, KG, this will be required that these companies are required to disclose that family charter or family agreement also. So a contradictory question which came before me during last session was whether a will will be treated as a document which is required to be disclosed. So now I'm posing this question to the audience, to Ramneet and to Ankit you also, whether a will be treated as a document which is required to be disclosed as per the amended SEBI LODR regulation. Very interesting, but very common answer.
But I have a point. Then you have to explain us the LODR regulation first. You had straight away throwing us bouncers without even giving us a net practice.
Just answer this one question, then we'll discuss it in detail. And
Okay,
I'll,
Ravneet.
Sir
Ravneet,
will answer.
you ask
Ankit sir will answer
you
first.
ask to the audience. You ask to the audience. Ankit sir half of the time stays with Kuldeep ji, so possibly might know the answer. But he has a very interesting question. So if a will is done, let's not lose the gravity of it. If a will is being made, say by the chairman of the company,
yes,
Kuldeep ji, right? Then whether this
Can
will needs to be
take the name
disclosed
of
in
chairman.
compliance,
Yes, chairman of the
of
company.
whether the will needs to be made in compliance to the LODR new guideline based on out of 14th July 2023. Ravneet, let's wait for some answers.
Sir, someone has answered that yes, now it is mandatory.
Kuldeep ji, you answer
I think
before
we
you
should
come
wait
on
for
me.
few more
No
answers.
answers.
Any other answer, Ramneet ji?
No, sir. Not yet, sir.
So should I answer, or should we wait, Ankit ji, for the answer to come?
I think we can, because you have to deliver the entire 2023
So
LODR.
to be precise, Ankit ji, the answer is no, because the very basic purpose or the very basic nature of will is it is a private document. If there has to be two parties for an agreement to take place. So it is not a family agreement. It is not a family arrangement. It is the discretion of an individual person. It is his or her personal property. A will is not an agreement or arrangement, and hence a will is not required to be disclosed. That is my opinion. It is not written anywhere specifically in the regulation itself, but from the practical knowledge that I have gained with working with Ankit ji with these listed companies, that a will is not a document or arrangement which is required to be disclosed, because it is not an agreement, it is not an arrangement, it is always one-sided. So this is the very basic reason why will is not required to be disclosed. Now your thoughts, Ankit ji, on this particular part.
I completely second. Whether an MOU is required to be disclosed?
Now it is a bouncer.
No, because Ranveer, let's also throw some counter bounce.
Yes, right,
But you will
sir.
be required to answer the same for us.
I have cheated the answer from your notebook, so don't worry.
And someone has answered that yes, it needs to be disclosed if that impacts the operations of the company.
Kuldeep ji, need your help. Whether an
You answer
MOU
it.
can.
First you answer it for us. Then I will pitch in.
So, to my opinion, an MOU is as good as an agreement and is enforceable. So, something which is enforceable, right, and in a form of an agreement needs to be disclosed. That is what I feel. If it is standing out on the principles of the materiality, which we have to discuss very quickly after this.
Agree with your answer, Ankit. You are right.
Thank God. At least I copied it right.
So we can move on to the integrated reporting, then quickly we'll come to.
Correct. So I'll open any annual report, and I would want to explain. Only thing is that we need to look into that this integrated framework came out of. Ravni, don't worry, इतना सब नहीं पढ़ाएंगे ना. इसमें से काफी चीजें we have discussed it while we were deliberating, so don't worry. So here we are, right? So integrated reporting is a voluntary framework mandated by top 500 listed companies, right? mandating top 500 listing company as voluntary initiative. So once importantly that it is not a mandatory thing or like a BRSR report on top 1000 companies. You have to voluntary. So now it has two important words which I want to tell to the learned audience here. One, mandating. Two, the voluntary part. Right. When we talk about voluntary, then how it is mandated? Any answers to this? So it says, SEBI says it is a voluntary initiative, but mandatory. Correct, Kuldeep ji?
Correct.
Ravneet, our audience needs to answer this.
Yes, sir.
Why voluntary and mandatory? How do you do both?
This is very interesting, and this is bouncer for all of us. Because these both things are contradictory to each other.
Right.
But यही तो SEBI का beauty है. It is like a earning presentation. Voluntary but mandatory. That means आप लोग किसी का आंसर आया क्या रवनीत?
No, sir.
दैट मीन्स आप लोग एक बार अगर IR फ्रेमवर्क अडॉप्ट करते हैं देन इट बिकम्स मैंडेटरी. सेबी कह रहा है वॉलेंटरीली अडॉप्ट तो कर लो, है ना. आओगे आप अपनी मर्जी से,
मैं
जाओ.
सेम डायलॉग बोलने वाला था.
जाओगे आप हमारी मर्जी से. So before you opt for a IR framework, please keep it in your mind that this needs to be voluntarily adopted, but once you adopt it, you can't get away with it. I'll tell you a very sensitive thing and a common problem with IIRC framework. And when we look at the reports of foreign companies, the Sri Lankan companies, the Bangladeshi companies, the countries which are very less developed than us, their annual reports are also correct and their integrated reports are also correct. I rarely found any integrated report as to be correct. I rarely found it. I am very sorry to say that we have just not understood the process of integrated reporting. Whenever I talk about integrated reporting, people say, yes, there are certain capitals, right? How do you disclose it? What is a value creation model? How do you create that value creation model? What is an input to it? What is an output to it? How do you quantify it? How do you quantify the input of each capital? How do you quantify? How do you undertake a materiality assessment? And how do you introduce your each capital? I think in times to come, Kuldeep ji, this will be the most interesting way to communicate to your investor. अभी तक the conventional business mindset was the financial capital. कितना पैसा लगाया और वो पैसा क्या ROI दे रहा है, क्या रिटर्न दे रहा है, how you are churning and burning that money. So there was an era before the startups came, Kuldeep ji, where people was talking about ROIs. People were talking about the return on investments. With lot of P's and angel funds coming in our country, we see lot of people talking about what is your burn rate and churn rate. ROI पे बात करनी बंद कर दी. अब जब इन सब का मर्जर हुआ, इन दोनों एरास का, जो अब हम 2023 में बैठे हैं, उसमें ये बात आई कि भाई this capital needs to be subdivided and every capital needs to add some value and there has to be a value creation model backing each capital, for which you have to define each capital, quantify each capital. So people are just talking subjective with their integrated reports. I think it's very important to benchmark the IIRC framework, Kuldeep ji. One. Two, there are 6 capital to it. I'll straight away open any company's annual report, whatever you say. Right. And we will. Kuldeep ji, you are on mute. You are on mute.
I'll say that we should go with Tata Steel only.
ARVR?
Yes, yes, ARVR one. But
Can
we
you
can.
can you do that
Should
if
I
you
play
have?
that ARVR portion or should I play the PDF part? Because in ARVR it will be difficult for.
Exactly. That's why I told you that maybe, we can just look at the PDF part, but I want, so see, I wanted a company where we can find certain more gaps, right? When you talk about
Hmm.
Tata Steel, they have been benchmarking it very well.
Then you can take any other report like Reliance or HUL or maybe Vedanta if you want.
No, Vedanta is enough discussed. I think I have Infosys report open. So
Infosys also okay.
let's open Infosys only now.
Sir, there is one question.
Okay.
Sir, integrated reporting also align with ESG reporting?
Yes, yes. At certain level, when you talk about your sixth capital, which is your
Hmm.
natural capital.
Natural capital.
So we have six capitals. I am coming on it. The natural capital is in alignment with sustainability reporting, but they are two separate things. From integrated reporting, your report starts, and from sustainability reporting, your report ends. So there are different things. Just I'll quickly take you to all the six capitals, but your natural capital needs to be in alignment. Give me 1 minute. No?
Yeah,
I'm
sure.
just navigating to integrated reporting. So here we start with the six capitals here. Now we find that visible.
Visible.
So these six capitals we are talking about. The first, everybody talks about a financial capital, right? Then you have your manufacturing capital, you have your human capital, you have your social and relationship capital, you have natural capital and intellectual capital. So while we talk about the social relationship capital, natural capital, and human capital, all these three are being talked at MDA section also to certain extent, and have been talked at the sustainability reporting. Since the reporting practices are still in evolving stage, so you will find that they are in complete alignment in next 3-5 years. But yes, these are the six capital, right? And integrated reporting is actually an interaction between these six capitals. So first, let's talk about introducing our capitals. How do you introduce it? Uh, Infosys have introduced their capital. Then they talked about interaction, how these capitals act as a synergy between
For
each
each
other.
other. Hmm.
And that synergy, now you can't just talk about, right? So when you look at the language, the capitals as introduced below provides a holistic perspective of how short, medium, long-term value uh, is created and
He is
preserved. Our
created.
strategy
Hmm.
and ESG vision guide to conducive interaction of the capitals, right? How needs to come, right? Synergy ये subjective है. How
Hmm.
these capitals affect performance of each other, and that can also, sometimes we can see it from the materiality assessment chart also, which can come. So now they have their value creation model in place, right? So they have their financial, intellectual, human capital, all these six capitals. ESG cannot be a value creation model. That is something which
Hmm.
I want to say. The value creation model has to come out of the process which you have of all these six capitals, right? On all the fronts, that is the business unit fronts, how we were adding. So if there has to be an improvement which we need to do in this report is the value creation model, which comes very generic. So which comes very generic. There has to be, as an IT company, They need to talk about their business process, creating value on each six capital. That is my individual perception. When you look at the IIRC framework, you will realize that fact also, and that is how you can show the complementing natures. So with financial capital, I think they have just talked about their net assets and cash and investments. Company says that it is their strength, right? However, the financial capital, the input part is not the net asset, Kuldeep ji. You would agree to that
Hmm.
point, right?
Yes, yes, I agree. It
Talk
cannot
about your
be.
talk
Hmm.
about your equity, talk about your
Hmm.
retained earnings, talk
Hmm.
about your cash and cash equivalents. I agree they
Hmm.
could be a
Hmm.
part,
Debt
but the
free.
financial capital is not. Talk about your debt if it is there,
Hmm.
right? What are your sources of capital needs to be known, and
Rather
what
than
out. Sorry.
rather than putting up net assets, they can, if it is so, then can use retained earning also.
Correct. Uh, with all this, right, what is the output which you expect, right?
Hmm.
The return on equity, the EPS, yes, they are the correct outcomes of the financial capital, and the revenue growth is not something which you should look at
Yes, yes.
as an output of a revenue capital.
Hmm.
So with intellectual capitals, right? So as Infosys, how many patents they have filed, how many trademarks they have been able to register, what is the know-how. Uh, I think they have just gone wrong on intellectual capital front as of now, what I am able to see. So intellectual capital should talk about, the newer things, right? Yes, they're talking to some extent, but could have been improved, right? Uh, yes, in output, they have talked about the patent portfolio, but what is the total number of patent at the beginning of the year and the total number of patents you are able to create in a year is an output. Your
Is an output.
patent portfolio is an input,
Input. Hmm.
right? So there's a confusion, and when you look into IRC framework, you will come to know. Similarly, you talk about your human capitals and your natural. Now, the natural and manufacturing capital has to go differently. When we talk about manufacturing capital, we need to, for a, Infosys can come up with their human capital is their manufacturing capital itself. So, because being a service provider company, but they can come up with the number of offices they own, right? The number of clients they are able to address. All these things can become a part of a manufactured capital. And finally, you have your social and relationship capital. In this, they have given the natural and manufactured capital together. IARC framework clearly prohibits you to do that. All these six capital needs to come together. If there is a remote possibility of clubbing a manufactured capital in Infosys case, in any service industry case, I would want to club it up with human capital. The value creation model is just not up to the mark, right? Then they have again come out with a chart. So that looks much better. This looks much better. This could be a value creation chart, but then how each capital is being influenced, or each capital is linked to this value creation chart is not coming out properly. Uh, I don't see materiality assessment and everything
Hmm.
coming up, Kuldeep ji. It should come right.
Ankit, can you
Rest.
throw some light for us that how and when a materiality assessment is required to be done as per the IIC framework?
So IIRC framework expects you to do a materiality assessment in 3 years, at least once
Hmm.
in 3 years,
So what
and
if
for
I'm
each
doing
capital.
materiality? Sorry.
No, no,
Please.
please
So
put
what
up your
if
question.
I've done my materiality assessment in the year 22, 23? Can I disclose the same in 23, 24, or what should I do if I'm not
No,
doing it
no.
on year
So
on
if
year
you're not doing
basis?
it, right, you have to give a statement that you have a policy of materiality assessment in every 3 years. But
Hmm.
whatever materiality assessment was for your last year cannot be for your this year,
Hmm.
for sure.
Hmm.
The
But
parameters have changed.
have you seen this sort of statement or positive affirmation which is given in any integrated annual report?
I think Vedanta only has given it.
Okay.
I know, but vaguely I remember.
Do you
Certain
remember a
companies.
bank's integrated annual report in which they have put in ATMs as a manufactured capital? Would you like to throw some light on that?
I rarely remember. It was HDFC.
Yes, it was HDFC. You're right.
Okay.
So
So
can ATM be a manufactured capital? I'm not sure about it.
no, not at all. Not at all. Not at all. Not at all. I am telling you, in Infosys case, Kuldeep ji, if you were on screen, they have
Yes, I
given
was on screen.
they have given their natural and manufactured capital together. It has no correlationship,
No correlationship.
right? Your manufacturing capital in a manufacturing company talks about the
Yes,
number
yes.
of plants you operate, your capacities you operate. They could have come up with their service delivery centers or whatever the number they have. So
But in any case, it cannot be clubbed. These two are like South Pole and North Poles.
so highly, there's a lot of scope to do as professionals. To my brothers and sisters, on the session, there is an immense scope around the value creation model. And chartered accountants today, Kuldeep ji, after integrated reporting, just can't talk about financial numbers.
Yes, they cannot.
They have to be digitally strong. The quantum of platforms Kuldeep ji use, you will be surprised to know while creating all these value creation charts. He is himself an expert to this. So you need to be good at graphics, you need to be good at a lot of things. The thought process needs to be innovative. Besides quantifying these capitals and benchmarking it to the framework, please don't limitize yourself to the financial skill. This will not work in the future era, as Nanda sir was also talking about. The future holds a lot of things subject to you are a cusp of both, high on financial skills and some good presentational skills. That's how I look at it. So, any question pertaining to IARC? Otherwise, because we are left with last 10 minutes of the session, Kuldeep ji. So,
So there is one question. Integrated reporting is a framework which can be presented as per the entity's suitable layout, like charts. This has been asked in the form of question.
No, they can't be. There is a proper framework to present it. There's a proper capital. The framework is benchmarked to IARC framework. Yes, Kuldeep ji.
It is not about the 2, 3, 4 pages which we have discussed about capitals or value creation model. The whole annual report and the presentation aspect has to be changed according to the IARC framework. So why we have discussed only these two aspects, because these are the important parts of the pillar of integrated reporting framework. But in other cases, the whole integrated report should be a thematic report which should flow in a way that it comprises of all six capital.
Each capital's value creation can be related and the correlationship can come out.
Exactly.
Is what is the ultimate objective. So I think with integrated reporting, Kuldeep ji, we come on the last part of the session, and which talks about LODR amendments. You are an expert to it. I'll try and understand from you. I am here, and wherever I can add some value to this changed rule. Now this comes out of this entire session comes out of the thought process. To all the audience, you have been very patiently listening us for 2 hours 40 minutes. Give us 10 very important minutes. I am telling you, Kuldeep ji, as an eye-opener session, last 10-minute session for you on this change. What change came on 14th July 2023? I want somebody to answer. What change and what was the change and what impact does he see? And then Kuldeep ji, over to you.
Sure. Should I open the PPT in my laptop or you are going to play it for me, Ankit ji?
I'm helping you. How will I learn
Thank
then?
You. It's your greatness that you are saying these things. So I'll rephrase the question for you, Ankit ji, that what all changes which have come into place, wide notification dated 14th of June 2023. Second, I want an answer about what was the rationale behind coming up with these changes. So there are two questions. One, what were the all changes which have come into place? Important changes, if you can identify, and if you can write it down for us in the chat box. And second is, what was the rationale behind these changes? Why SEBI is coming up so high with the regulation 30? Why there is a talk and there is a even cry about regulation 30 all of a sudden? Was it required or was it not required? Any answers, Ravneet, as of now?
Kuldeep ji, I am off webinar for 2-3 minutes. I'll be back.
Sure. So then I'm playing this PPT from
No,
my
sir.
part. My laptop.
By the time you conclude, I'll be there.
Okay, fine. Ravneet, give me a few seconds. I am just opening the PPT.
Yes, sure, sir.
Is it visible?
Sir, wait a minute. Yes, sir.
Yes, it's visible.
Do we
Yes,
have
sir.
any answer, Ravneet, as of now?
Sir.
So before I start with, because this LODR amendment can be taken as
Sir,
yes,
someone has answered that materiality definition has changed.
okay. Answer number one that I was expecting that somebody will answer about materiality. Any other answer?
No, sir.
So let me straight come to the point, Ravneet and Ankit, because what has changed in this LODR amendment regulation is SEBI has come up with somewhere around more than 30 changes in the LODR regulations. And first question was what all major changes which came into place by notification dated 14th of June. The answer is first is it is about mortality. Why mortality? Because you see on the screen that there is a globe which is roaming around and it is showing various stock exchanges which are there outside India also. So what was the reporting practices which was being followed on other stock exchanges or on other countries? If you can apprise of the fact that when you see Security Exchange Council, that is the regulator for US based listed companies, when you see SSC Canada, when you see SSC Australia, you will see that this mortality regulation or this mortality threshold was there already. The reason behind coming up with these, amendments, SEBI has specifically, stated the same thing in the consultation papers. So for the benefit of the audience, I would like to, tell few things that before you read this amendment notification, if you have not read yet, you should go and read the consultation papers first. The kind of dilemma, the kind of issues that we are thinking, which are arising in the company's corporate world in practical life also, you will get approximately 1/3 of the answers from these consultation papers. As to when yesterday we were sitting with one of the CFOs, as I was already discussing in the beginning, they were saying that what was the reason why SEBI is coming so high on regulation 30? ऐसा हमने क्या गलत कर दिया? We were reporting the same. ऐसा तो कुछ हुआ ही नहीं था. Then they said that they went to MCA. I'll talk about practical part only because theoretical part is not possible to be covered in 20 minutes. It is a separate 2-3 hour session. So they said that we went to MCA and SEBI and we asked that, boss, what was the reason behind coming up with these regulations? So SEBI has said that there were 2-3 basic reasons, Ravneet. If you and other audience and Ankitji will appreciate the fact that there is a schedule 3, not the one which is there in financial statement. There is a schedule 3 and SEBI LODR regulation, which has few parts. There is part A, which has 2 paras, para A and para B. So previously, there are 2 type of events which are required to be disclosed. One is deemed material event, which has certain events listed. It is an exhaustive list. Like you can take an example of selling of any unit of a company, declaration of dividend. If you say spin-off of any company, any sort of, material agreement which the company has entered into, there are 20 odd events which have been mentioned. These events are required to be reported irrespective of the fact whether they are material or not. So when you talk about deemed material events, you need not to apply the test of materiality, which is the talk of the town as of now in through the sectors. Whether you talk about any compliance officer, whether you talk or speak to any CFO, anyone in the industry, everybody is busy in dissecting what is to be reported and what is not to be reported. Because in these regulations, the onus on the company is that they need to look into the past also. It is not all about the events which are taking place in future. They need to report the transaction which has taken place in the past also. So coming back to the point, why it is required, why this amendment made, there is a part B of para A, there is a part para B of, sorry, part A, which says that the event which are not deemed material event are required to be tested for materiality. And the problem lies here only, Ravneet and Ankit ji, that the companies were taking benefit of this discretionary provision which was there. So in almost all cases, the intent of having a LODR regulation or intent of disclosure of material information is that to mitigate the information asymmetry part. And what you understand with the information asymmetry, there can be two aspects of looking at information asymmetry. One is that, like you, me, and Ankit are three different listed entities. Ankit is Tata Steel, you may be HDFC, and maybe any other entity, say Vedanta. So you are disclosing in a different way. I am disclosing in a different way, and the other entity is disclosing in a different way. The quantum of information that you are pushing through the stock exchanges to the stakeholders is also different. So there is a asymmetry of information about the qualitative information on the quantum of data which we both three, being a listed company, the regulation is applicable on all the companies in the same way. The information was not being disseminated in the same way. And second is, the information asymmetry means that the information is available with the company, but with any purpose, be it intentional or unintentional, the information is not being disseminated to the investor. So basically, if there is anything which is required to be reported to the investor, which is required to be disseminated to the investor, it becomes an part of information asymmetry. So the first reason was to mitigate the information asymmetry, and the second reason was to, eradicate that subjectivity part out of it. So if you see, whenever you tell that there is a discretion of you, me, any KMP or any board member, it will be subject to, test of materiality also. The companies was very well, able to get away with the disclosure requirements by stating the fact that a particular information or event is not material because it is not as per the amendment policy, it is not as per the materiality policy of the company. So these were the two basic reasons, these were the two basic, issues due to which SEBI has come up with these amendment regulation, and the major amendment forms part as regulation 30, which talks about materiality. So coming straight to the materiality part, how it is to be calculated. If you talk about SEC, that is Security Exchange Council, it is in US. There is a materiality threshold of profit, 5% of the profit. If you talk about Canada, it is 10%. If you talk about Australia, it is 5%. Hence, SEBI has come up with three type of quantitative threshold for the materiality concept. Can you answer it for me, Ravneet? Are you aware of these amendments? Because it is very relevant as of now, and it is almost there in all forums wherever we go. If I am discussing about India's, only the people of a listed company will ask about, boss, what to do with these amendment regulations. Are you aware of any of the quantitative threshold which SEBI has introduced?
No, sir.
My bouncer was for you, Ravneet, because Ankit is not online as of now. He is off screen, to be precise. So I am coming to the answer. I'll not, trouble you much about this. So these are the key changes which have come into place in SEBI LODR Regulation 30. First is quantitative threshold, which is being introduced. The main reason behind this is to remove the subjectivity and bring in the objectivity and uniformity in the part that the companies are, able to identify a material event based on the same sort of quantitative criteria. So there is a criteria of 2 to 5. 2% is average of consolidated turnover. 2% is average of consolidated turnover. Second 2% is for the net worth. It is 2% of the consolidated net worth, with a rider that if your net worth is negative, then you are not required to consider it for the threshold calculation purpose. Third criteria is that 5% of the average net profit. And interestingly, the word here mentioned is absolute. Can you tell, can anybody answer it for me? What does absolute means? what does absolute means in calculation of the average net profit for the identification of quantification of the qualification criteria for materiality events?
Someone has answered that investor holding more than 5% of total shareholding.
Ravneet, it is, I think it is very
I think
serious.
it was
Yes,
before.
yes.
Yeah, yeah.
It is very serious on our part also. The 5% criteria is related to average profits, and why they are talking about absolute means, be it a profit or be it loss. Absolute means in mathematical terms, if you go back to our schooling days, absolute means it will be considered irrespective of the fact it is a negative figure or it is a positive figure. And what is the rationale behind coming up with these absolute terms? Because there may be a seasonal business, there may be a seasonal issue, there may be an issue once in few years. Like if you talk about the COVID event, COVID was a black swan event in terms of investor fraternity. Black swan event is the event which takes place once in 100 years or once in like 20, 30, 40 years. So there can be a year which is a bad year for the company. Like if you are dealing into some commodities which are directly related to, say, China. So if the government next day comes up with a policy that for next 6 or 7 or 9 months the import is banned or the export is banned, then your entity is going to be affected to a larger extent. And in this case, you will be representing a lower profit or you may be representing a loss. In other case, if you talk about banking sector, there may be a case in which in a year a major fraud has been identified and then an account was termed as NPA or it slipped into NPA and hence affecting the profitability of the bank. The bank may be in losses in that particular year. So the rationale behind coming up with this absolute word is that to account for both ups and downs of the company's business operating performance. Now the second question comes up is, what is the reason of having these three materiality thresholds? Can anybody answer, or else Sankitji will answer it for us? Sir, you are on mute.
No, I am not speaking only.
So
While
without
when
taking
you posed a question to Navneet, I was there also.
So without taking much time, the rationale behind coming up with these three sort of quantitative threshold is that in most of the countries, when you see the global framework, there is a requirement related to profit only, that is bottom line. There is no such requirement related to turnover or net worth, etc. per se. But when you read the consultation paper of SEBI, which was issued in November 22 and February 23, you will appreciate the fact that SEBI has given a very valid reason. Say you take example of a bank. When you are lending money, it becomes an asset for you. You agree, Ankitji? Ravneet, you agree with this?
Agreed.
When you are earning interest on that particular part, then it will become part of your P&L. Again, I think you will agree to the fact when it becomes an NPA, it affects your profits and it affects your balance sheet. So it hits your net worth also. So SEBI is saying that every transaction, every financial transaction, since it is a double entry accounting system, it has at least dual impact on your financial statements, be it on profit and loss and be it on balance sheet. So for that very purpose, this threshold of net worth, turnover, and profit and loss is required to present a fair picture. So straightforward, coming on the part how to identify and how to dissect whether information is material information or not. First, you need to see whether it is a deemed material event. If the answer is yes, then you need not to apply mind. Be it a company, be it from the consultant side, you need not to apply your mind. You straightforward go and disclose that information, because there is no
one thing to break the tempo. The timing is also very important.
Yes.
Not the 9 p.m. time, but the timing of disclosing this information.
Yes, timing of disclosure is very important. And since you have broken the tempo, I would like to give a small formula how to see in what time an event is required to be reported. So there are three changes. One says that a event is required to be disclosed in 12 hours. The other says that event is required to be disclosed in 24 hours, and the third one is 30 minutes. So basically 30 minutes is about the events which takes place in the board meeting.
Very
Like
significant. They
very
would
significant events.
be very material.
Yes, it's very material. These sort of events were described in part C of schedule 3 previously also. It is like this declaration of dividends. Like if there is any dividend which was declared previously, now it is being cancelled. Any sort of strategic decision which is being taken place, like the company is appointing an independent director, it can be because it comes out of the board meeting. So you need to have a materiality, you need to have a litmus test for the timelines itself, Ankit. And it is very small and very easy formula. You see just two things. If the information is emanating within the entity, you apply your practical mind and knowledge. If it is emanating from within the entity, then the timeline is 12 hours. If it is emanating from outside the entity, then the timeline is 24 hours. And it is very easy because there can be n number of cases, n number of practical situation. Not every situation is given in the amendment regulation notification master circular. So you apply this test. If it is within the entity, if it is from within the entity, 12-hour rule is applied. If it is outside the entity, 24-hour rule is applied. Anything you want to add on to this, Ankit?
Only thing I feel is that there is a lot of guidance which is to be required barring the circular.
Yes, yes,
circular
exactly.
talks about lot of subjective things, and we both have spoken at the level of institute to undertake a project on it that we can come out with some guidance. So that project is in a approval process, but I think there are subjective things. For example, while we were a couple of days back, we were in a boardroom and a company was trying to fill vacancy of their CFO. They were asking whether we should disclose it or not. Sometimes a vacancy of CFO or CEO is driven by the chairman or the top management of the company. Even the entire board doesn't knows about it. The board knows about it when the vacancy is filled, not when you start finding a role of a CFO. So
whether it is a information emanating within the entity or outside, Ankit?
Within
the entity. So it is required to be disclosed within 12 hours. So again, it becomes a very tricky question.
That company says that even the investor relation team says we don't know whether our CFO is changing.
Coming back on this timeline topic, there is a very tricky situation for the compliance officers who are, if any CA is working as a compliance officer, like I've come across two people in past week. One is, I think, Ankit, the company secretary of Balrampur Chini. He is also a CA. Another one was,
I think he's a company secretary.
He's also a CA.
Okay, I am not
aware. He is also a CA. So there may be some chartered accountants who are working as a company secretaries or compliance officers in the company. The timelines are very stringent, Ankit, and it is without any sort of relaxation. So if you see practically when information reaches to me at 10 p.m. in the night, so the literal interpretation of this regulation says I have only 12 hours and I need to report it before 10 a.m. in the morning next day, which is practically not possible. If the information reaches to me on a Saturday evening, late evening, and I have 24 hours to be specific, then I need to report it before the end of Sunday itself. And again, it is not a doable task in many companies because the timelines are without any sort of relaxation, without any sort of exceptions for weekends or
working hours or
office hours.
Weekends relaxation. I get your point.
Some other important amendment, which is also a very subjective and very tricky part for the companies. At one part, they've specified that any sort of fine or penalty. So it is an amendment in regulation 34 itself. It is out of the test criteria of materiality. If there is any fine or penalty which is being imposed on a company, it is required to be disclosed irrespective of the amount. They have not written irrespective of the amount, but the literal meaning says that it is required to be disclosed. So, Ankit, you will appreciate the fact that the exchange is the only point of contact between a stakeholder and a company.
Correct.
And if, as a company of size of Reliance or HDFC Bank, there will be thousands of notices and finance penalties which are there, which will arise on daily basis or on quarterly or weekly basis. So if I start disseminating the information to the exchanges, the exchange will become a timeline ticker for the fines and penalties relating to the company. So then it will become a trivial information. A trivial information means which is not important for the readers to know, and it will suppress what material information is required to be given. So my practical view on this particular part is, though it is not given in the SEBI regulation amendment, and it is my personal opinion, there are two parts to look at it. One is if there is any fine and penalty which has a material impact on the company's financial statement, then it is required to be disclosed to the exchanges. Second is if any information is already being designated through the contingent liability notes to accounts, then I believe, and the intent of statute is that it is already being conceived by the stakeholder as it is, so it is not required to be re-reported. And Ankit, the problem is not about reporting the same. The problem is that as soon as you report or any frivolous or trivial data that you push to the exchanges, at each and every stage of that particular case or particular litigation, you need to update about what is going on in the case. Each and every stage, you will need to be filing a specific and fresh information. So it will become a nuisance.
The quantum of information is what you are saying becomes important.
Yes,
For
yes.
example, in case of contingent liability, right? I think the company was Tata Teleservices, or which company?
Yes, Tata Teleservices. Tata Teleservices.
They reported their contingent liabilities and media picked it and made a hype out of it.
And
they were already existing in the company. So
exactly. Ankit, I'll just take 5 minutes more and then we'll sum up. If you allow, Ramneet, can we take 5 minutes more?
Yes, sir.
So that I can finish that materiality part itself.
Right.
So Ankit, you are very right in mentioning the Tata Teleservices part. You see that we need not to be expert in SEBI LODR or listing regulations. From a prudent financial mind, we can say that if there is any information which is already being pushed through the notes on contingent liabilities, it is already there in the mind of stakeholders. So the statute is not requiring you to report the same again and again. If there is any additional fine and penalty, which is being, say, if you have already reported in the contingent liability due to decision of a case which is against the company, a demand of 50 crore is being imposed on the company, it is already there in the contingent liability. If there is any additional demand at any other stage, then in that case, that additional demand is required to be disclosed. But you are not required to disclose each and everything. You take example of any bank or any company which is having more than, say, 100, 200 offices across the India. There may be a small fine of municipality. See, after the implementation of Swachh Bharat plan, there are fines which are being imposed on the companies for not maintaining the hygiene practices also. So if there is any such fine, it is a trivial information, but if you go by the plain reading of the statute, then you will disclose each and everything. It is also not right. So coming back on the topic, since we have paucity of time, if it is not a material event, deemed material event as per para A, part A, then you are required to calculate the quantitative threshold. The quantitative threshold, you can remember 2 to 5. The second part you need to remember is always you apply it on consolidated basis. Third is that the profit has to be in absolute terms. If it is a loss or a profit, you need to add up it to calculate the average. Fourth part is that when you talk about consolidation, see, there is a query which came to me past week. Ravneet, if you can apprise of the fact that there is a subsidiary like A is subsidiary of B Limited. A is reporting something based on its own materiality criteria. So as a holding company, do I need to report the same? The plain reading of the statute says that you need to report the same, but the answer is no. The answer is no, because it is the regulation pertains to specific listed entities. It doesn't talks about if something is being reported by a subsidiary, I need to report the same. But on the contrary part, it talks about journal test of materiality also, journal practical test also, like significant market reaction. And the word false market is being used at many times in this amendment regulation. False market means that the picture of the company should be true and fair in the eyes of stakeholders by the information which the company is disseminating. So if you see that A is a material subsidiary of B, and if there is any adverse event which is happening in A, like any mining leasing being cancelled or the operations are being shut off then it can have an impact on the consolidated financial statement also. So in that case, the holding may disclose the same, but not in journal cases, because otherwise every information which you are designating as a my subsidiary, I will be designating the same information,
Right.
and it will lead into duplicacy of the data.
Right.
So coming up to the third part, before we finish, we need to determine the value or expected impact in terms of value. So we'll appreciate the fact. I will take 2 more minutes, Ankit, 2 more minutes. I'm sorry I was late, so I'm just trying to,
No worries, no worries. I
fill it
think
up to the extent possible.
right.
One is value. Value means that the absolute impact which is identifiable. So if you are making any investment, if you are taking any decision, if you are entering into any arrangement which has a direct quantifiable amount attached to it, monetary limit attached to it, and it is crossing the threshold limit, then it is very easy for the company to disclose it, because it has crossed the quantifiable limit and it can be identified in value terms. The second word which SEBI has used is expected impact in terms of value, Ankit, and it is very interesting also. Expected impact in terms of value means that if in case of any transaction, the impact in terms of amount is not identified as of now, if it is a running event, it may have a greater impact in future. For example, you are putting up any new production line in your plant and factory center, and that production line is going to significantly enhance your quality of product, thereby reducing the cost of production, and it increases the production capacity also, so thereby increasing your sales. So it has direct impact on top line and both bottom line. So as of now, if I see in absolute terms, the value is not as such that it is crossing the threshold limit. But if I see the expected impact in terms of turnover or in terms of profit in future, it will be significant. It has passed the materiality test and you are required to disclose. So before we sum up this materiality part, there is a rule of correspondence which is required to be followed. So if you see, there can be two cases. One, if you don't apply this materiality test diligently, either it will give always a pass result or it will give always a fail result. So if you are comparing impact of a particular event on turnover, then in my opinion, you should correlate it with the turnover threshold, because an impact on turnover will always be higher than the profit threshold, and hence the rule of correspondence comes into play. As we all are chartered accountants, we see that in India also it is written that comparable financial information is to be given. The data has to be comparative, and we write also in our balance sheet that previous year's figures have been regrouped and reclassified for the purpose of comparative analysis. So this is the same case in quantitative or materiality threshold also. The rule of correspondence will come into play. So if you are analyzing an impact in terms of profit, and interestingly, if you are applying it to the quantitative threshold that you have derived for say turnover, then the result will always be negative. So in both cases, it will give the false result. So you need to have same comparable threshold for the impact that you are assessing. So after determining the value or expected impact in terms of value, you need to identify, you need to compare it with the quantitative threshold. Then if it is a material event, then you are required to disclose. Even if it is not a material event as per this particular quantitative threshold which is given, there is a specific line which is being added in regulation 34(1)(d), which says that if there is anything which is falling in the materiality policy derived by the board, which is material in discretion of the board, the materiality policy is in line with the regulation 30 amendments, because it specifically says it cannot contravene the provision of amendment regulations. Then also it can be a event which is required to be disclosed. So since we have paucity of time, I will put my words to stop here. I would like to be part of such sessions along with Ankitji, where we can take in a separate session on integrated reporting and SEBI LODR regulation per se, because they are very interesting topics to be discussed upon. There are only practical questions or practical queries with which you can discuss for 4-5 hours also, because since it is a very relatively new concept, integrated reporting relatively new amendment. People have not gone to the through the test of practicality as of now, because as sooner or later the events will come, we'll see many more litigations or many more interpretations from different individuals of these regulations. But to sum up, I would like to say that you should focus on materiality while you are assessing this SEBI LODR amendment regulations. Trivial information should not overrule or should not suppress the materiality fact. It is as good as obscuring the information. Like we all know that grass के साथ weed भी उगती है sir, और अगर time से weed को नहीं काटेंगे तो it will take over the grass. The same situation will happen if we'll not focus on materiality. So with these words, I put up my words to stop and handing over to Ankit ji for the final concluding remarks, and then Ravneet.
Kuldeep ji, hats off to you. I'll tell you, everyone in the audience, he had a physical session at Noida at 2 to 5. And I am sure, he just traveled back for another session. He's somebody who has been deliberating in India around this topic for the cause of the profession.
Along
And-
with you, Ankit ji, only you need to mention this fact also.
But it is like a, hats off for 6 hours continuous session which you have been taking. And I
And
salute
with full of energy, sir.
with full of energy, with no, with so much of insight that I am sure that I was looking forward to hear more. But you're right, there paucity of time. We both, or we three, Ravneet, I or Kuldeep ji, never wanted to pose any problem in front of you. I am telling you one-liner solutions to it. One, have a SOP for your investor relationship team. I am telling you, a SOP is a mandatory thing. It has become a department and a very essential department too. And this SOP will be circulated to various departments. There could be a purchase transaction, there could be a strategic transaction, there could be a HR transaction. Everything needs to be reported. Why not have a SOP around the new LODR thing? Two, your financial disclosures will undergo revision. Get it done right now. Else, you will see very difficulty in closing with your statutory auditors in times to come, because a statutory auditor might have a different view of the materiality and you might have a different view of materiality. Three, whether mandatory or not, important or compliance, an investor presentation needs to come up for a better enhancement of the, for the enhancement of the communication with the stakeholder. Or I think the annual reports are another thing which are the best way, still the best way to communicate. The non-financial part needs to come out well. The integrated reporting practice, even though it is a voluntary adoption, every company should come up to gain more traction in the eyes of the investors. For all, I think these are 4 or 5 key takeaways which I would want to sum up. For all those who have still lot of queries, Ravneet, if you can help us, I am mentioning an email ID since I can't communicate. They can communicate on this email. We will surely answer every query within, a week. The email ID is info, info. If you can
Info.
write in the chat box, @adwin, ADWIN, Adwin Advisory, ADVISORY, adwinadvisory.com. And I, Kuldeep, or even Ravneet, we will try to answer these things. We are very sorry for throwing some tough questions to you. Even with
No
on an
problem.
audience side, we will not find answers to it. As speakers also, we don't find answers to it. Even if you're not able to note your email ID, connect to us on LinkedIn. I think there is a lot to do on all the fronts. Investor relationship is no longer an easy job, is a around the year 24/7 job, which nobody understands in the company. Only we professionals only can understand. Hope we did not wasted your Saturday evening.
No. Sir, it was really such a wonderful and informative session. And
one more
I
thing to
enjoyed a lot.
interrupt. One more thing to interrupt Ankit ji and Ravneet
Yes,
before we
sir.
sum up, before you give your concluding remarks. That Ankit ji was talking about that SOP policy. So it is it is for all the persons who are attending this webinar and who are in some senior management positions or relevant employees within the definition of the SEBI amendment regulation. Ankit ji, it is very important for them, because yesterday when I was deliberating, and today also, we had a very heated or interactive conversation with the reporting team of a bank, when I asked that who are the relevant employees. So they said that nahi koi nahi hai, CFO is the relevant employee. There is a specific definition of functional heads, relevant employees, SMPs, which is being given in LODI regulation. Or
Yes.
these
Yes.
persons are not responsible for dissemination of information to the exchanges, but these persons are responsible for passing on the information to the KMPs. And this will come into play when there will be any misstatement or the omission of any disclosure of material event. It will come into play. So as a relevant employee, as a functional head, as a senior management personnel, there has to be an SOP around this also, that how you fetch information from your relevant employees. So adding on to your SOP part, this is also a part of important SOP metrics altogether, which is required to be made for investor relationship. Over to you, Ravneet.
Yes, sir. So, thank you, sir. I sincerely convey my thanks to CA Charanjot Singh Nanda, sir, CA Kotha S. Srinivas, sir, CA Ankit Maheshwari, sir, and CA Kuldeep Kothari, sir, for such a wonderful and informative session, and all the participants here for such an active participation. Thank you all. Good night, sir.
Thank you.
Good to go. Good night.
Okay.
Bye.
Good night.
Okay, bye.
Thank you, everyone. Thank you.